Okay, good morning to everyone. Welcome back. Attorney Pace, do we want to start with the read-ins?
Yes, and good morning to the commissioners. Good morning to all the parties. The last two read-ins that we need to cover would be, the first one is read-in T that asks the company to identify the rate year treatment of the cost of the Customer Assistance Program, or CAP. And Ms. Zabo, can you respond to read-in T?
Yes, the cost for that program in the test year were below the line, and we did not make any adjustments for the rate year. So for rate making purposes, those costs have been excluded.
Thank you.
The next read-in was read-in T.
Wait, that was read-in T, right?
I'm sorry, I apologize, Chairman. The next read-in was read-in U. And read-in U had asked the company to identify the cost of any stipends provided to participants in the Customer Advisory Board and whether or not any such stipends were in rates. And that was directed to Ms. Zabo. And if Ms. Texera has anything she can add also. Can we start with either of you, please? Thank you.
So the stipend paid related to that program in the test year was $600. It related to one meeting that was held during 2021 where 14 members attended. 6 members were paid a $100 stipend, and that cost is reflected in our test year and rate making proposal.
Okay, thank you.
Yeah, there was another focus group cost that was referenced, but those costs were incurred in 2018 and not in the test year.
Okay, thank you. So just the $600.
Yes.
Okay, thank you. Okay, so I think we're all caught up.
Yes, Chairman.
Read-ins. Okay, and give me a moment to pull up our file. Just a minute. Okay, then we are going to resume with our cross-examination of the cost of capital panel. So Director Lopez, the floor is yours, sir.
Thank you very much, Chairman. Morning again, Mr. Novak. If you don't mind, I'd just, before we finished yesterday, I directed your attention to your figure 11, which was the Moody's ratings actions on New York utilities. I believe that was on page 45 of your direct testimony.
Morning, Mr. Lopez. Yes, I'm there.
Excellent, thank you. And I want to make sure I start where I left off. So if you don't mind, I'd like to just kind of take a look at these and ask you a few questions related to those. Are you aware, one of the companies listed is Con Ed, and in figure 11, you note downgraded on date March 2020. Are you aware Con Ed had a rate case in 2019?
I'm not aware of the specific timing of their rate case. I'm aware that they're on a roughly 3-year cycle. That's consistent with my understanding about when they would have been in.
Okay, and were you aware that and again, just asking, it's okay if you're not. The company asked for a 10% ROE in that rate case?
I'm not aware of what their specific ROE request was in that case.
Okay, and are you aware that a joint proposal settled on an 8.8% ROE in January 2020? In that rate case?
The specific determinations of those rate cases, I'm not aware. As it relates to this table was created by a Moody's publication that was talking about the general trend in ratings actions for these companies. As to the specific determinations, those would be embedded in the specific ratings action reports. Those are not what I relied on in developing those tables. So as to the specifics of ROEs or anything like that, I may be familiar with some components of some of the cases, but not all.
That's fine. I appreciate that. And so you note that Con Ed was downgraded in March of 2020. Are you aware that in the third quarter of 2022, their outlook listed by the S&P was stable for Con Ed?
No, I haven't gone back to look at these specific companies to see what circumstances have changed. I believe Con Ed has gone in for another rate case since that time.
Okay. And I'm assuming you're not aware that in February and March 2022, Moody's and Fitch rated Con Ed at stable outlook.
No, again, I haven't looked at the specific ratings of these companies subsequent to that, nor the conditions by which there may have been improvements in the regulatory outlook or any other considerations that may account for that.
So you're not aware that their ROE has remained at 8.8%?
Again, my understanding is that Con Ed, again, consistent with their cycle, has probably gone back in to the extent that their new request was premised on a different ROE, and to the extent Moody's took that into account in making their projections, that I'm not sure how much that factored into that decision.
Okay, thank you. Move on to Central Hudson. And again, here you note Central Hudson Gas and Electric received a negative outlook in October of 2020. And are you aware that 2018 decision? So are you aware, and it's okay if you're not again, Central Hudson requested a 9.5% ROE in its last rate case?
Again, I'm much like Con Ed, I don't know what the specific request was in that proceeding.
Okay, and so a 2018, are you aware that a 2018 decision granted an 8.8% ROE for Central Hudson?
I'm not aware of that specific determination, but I know at that point in time that is generally consistent with the specific New York methodology that they were using in that case. New York performed a generic cost of capital proceeding, much like Connecticut a number of years ago. And they have pretty strictly adhered to that with deviations over time. So whereas we have different witnesses presenting different models here, they have a fairly prescribed construct by which they determine ROE. And the 8.8 determination, I don't know specifically that that was the Central Hudson case, but I do know that there were 8.8% authorizations based on that New York methodology at that point in time.
Okay, thank you. And obviously you note in your testimony that Moody's negative outlook was given in October 2020. Were you aware that Moody's downgrade was also based on its views on a growing capital expenditure program and the ongoing impacts of federal tax reform?
There were several factors that weigh into these determinations. The regulatory construct is an important component that takes, in Moody's criteria, that's approximately 50% of their weightings. So there is never a single factor, in my view, that leads to a downgrade absent a specific action. It's the overall review of the credit metrics, the regulatory construct. Many things factor into these decisions.
Thank you. And were you aware that Fitch and S&P maintained the company's outlook, Central Hudson, as stable?
I haven't specifically looked at the Fitch or S&P ratings of these companies.
Okay, thank you. Were you aware that in June 2021, the company itself stated that CH Energy Group and Central Hudson believe they will be able to meet their short-term and long-term cash requirements given the flexibility awarded under the 2018 rate order, including a return on equity of 8.8%?
When you say the company you're speaking, is it CH Energy?
CH Energy Group.
Yeah, no, I'm not aware of it nonetheless.
Thank you. And if I could go to Niagara Mohawk. And I think in that case, you recommended is it correct that you recommended a 9.5% ROE in that case?
I'm trying to recall the specifics of that case. I believe 9.5 is generally, it was within the range. As to whether or not that was my specific recommendation or what the company specified from within that range, I don't recall specifically.
Okay. Were you aware that there was a joint proposal that settled on a 9.0% ROE in that case?
I'm aware that that was what was settled upon after a very lengthy settlement procedure that was really outside the norm of the typical settlement period in New York. It was a very extended settlement period, and yes, the 9% is what I recall being the settled upon ROE after several gives and takes between the company, commission staff, and other parties.
Understood. Thank you. And are you aware that in it's a 2021, 2022 annual report, National Grid, which is the parent of Niagara Mohawk, noted that the net revenues in New York increased by 126 million from the benefits of the rate case increases in Kedney, Kedley, and Niagara Mohawk?
I have not reviewed the National Grid 2021 annual report.
Okay, thank you. So in this case, and this is my last line here, so we're almost done. Thank you. I appreciate you bearing with me. So you recommended a 10.35% ROE in this case, correct?
That's correct.
And so are you aware of any water company who is authorized a 10% or higher ROE in 2022 in any jurisdiction?
In 2022, I'm not aware. I had limited data in preparing my rebuttal testimony. There's really very few water cases that are published by RRA, which is the typical publication I look at. But I would note a couple things in that there's very little data for 2022 thus far, to my knowledge. And authorized ROEs tend to be, there tends to be a lag in the decision from the capital market conditions to which it's responding. Today, we're building the record of evidence for this case. The decision will come out sometime after. I think what's been important about 2022 is all the evidence that we've seen of rising interest rates, rising capital costs. So the evidence that we see of rising capital costs may be lagged in those authorized ROEs. When we go back to 21 and 20, those are reflecting lower interest rates, evidence of lower capital cost environments than where we are today. We would have to go prior to 2020 to look at a period where interest rates are comparable to where we are today. And when you go prior to that 2021 period, we do see evidence of ROEs that have been authorized above the 10.35, including the 10.5 for AQUARION in Massachusetts that I've included in figure 2 of my rebuttal testimony to Mr. Rothschild. That's on page 10 of that testimony. At that point in time, we saw the 30-year Treasury yield in the neighborhood of, it was in somewhere between 3%, 3.5%, close to that at the time of that decision. Again, today, recently we've seen the Treasury yield above that. As of yesterday, I believe it was at about 3.55. So that from an interest rate perspective, that's when capital costs were, the cost of capital was on a more comparable basis.
Thank you. Thank you. I appreciate it. I have no further questions. Thank you.
Thank you. Is EOE's cross-examination complete?
Yes, thank you, Madam Chairman.
All right, thank you. Okay, we'll turn to questions from the bench. Commissioner Karen, any questions for this panel? Thank you, Mr. Vice Chairman.
No, Madam Chairman, thank you.
Okay, thank you. I have a few questions. I'm gonna like to start with Ms. O'Neill, please. So when we're speaking about financial ratios generally, would you be able to articulate to me what financial ratios are considered core as opposed to supplemental by the rating agency, please. And if you could just make sure the microphone is on. Thank you.
Sure, I'd be happy to. I could talk to the Moody's one more specifically because the company is not rated by S&P.
Okay.
I'd like to refer you to RRU-59, attachment number 2. Page 6. Under leverage and coverage, all 4 of these are considered core. So it would be FFO interest coverage, debt to cap, FFO to debt, and retained cash flows to debt.
And those are the ones that are considered core for Moody's.
Yes.
Okay. And is that based on a publication from Moody's or based on your experience, please?
It's based on the Moody's methodology. This is their methodology of how they determine the rating. So 40% of the rating is due to these metrics, 50% is due to the business profile. And then we have some 10% is due to financial policy.
Thank you. And that methodology is published?
Yes, it is. It's the Moody's report. So it's attachment number 1 that I'm referring to.
Thank you.
So it's the response to RRU 59, attachment number 1 is the Moody's report. It's entitled Rating Methodology, Regulated Water Utilities.
Thank you. And the exercise that you just walked me through right now, you described the metrics that you that you believe Moody's considers core. Does that mean that all other metrics that were not just referenced are considered supplementary?
That's correct.
Thank you. To your knowledge, would that classification between core versus supplementary differ based on the sector, like water versus electric versus gas?
If, to my knowledge, if it differs, which it could differ, but I don't think it would differ substantially, because essentially what they're trying to capture in these metrics is cash flow and leverage.
Thank you. And if a ratio is one of the supplemental ratios and they fall outside of the rating range that the company is currently in, does that, I'm sorry, let me rephrase this. So if a supplemental ratio falls outside of a rating range that is being targeted by the company, does that concern the company, or conversely, does it concern Moody's?
I want to respond the same to both. Not really, no.
Thank you. I'm sorry, I didn't mean to cut you off.
No, the supplemental ones are considered very superfluous to the core.
Okay, thank you. Do you know then what the purpose of tracking the supplemental ratios is?
My understanding is the purpose is just another means of evaluating the company.
Thank you. And if you know, could you speak to how the rating agencies are compensated? for the work that they do? Is it through subscriptions, through fees that a company pays to it?
Sure, I'd be happy to. So there's what's called a Chinese wall between the business people at the rating agencies who I deal with and our rating analysts. So the business people who charge us the fees cannot speak to the rating analysts because there is a Chinese wall.
Okay. So it's AQUARION or similarly situated companies pay a fee to the business side of the rating agencies.
Okay. AQUARION would actually, so because AQUARION does not issue public debt, the rating agencies do not charge for a private debt offering. They're non-SEC entity, but I would imagine that AQUARION probably pays, so Eversource pays fees based upon how much debt they issue and how much debt is outstanding. So I imagine a very, very small piece of that would be charged to AQUARION.
Thank you. And Ms. Sabo, this may be a question for you. Are those fees then in the cost of service of AQUARION?
Yes, so they're charged to AQUARION and then they're allocated to the operating utilities using the MAS formula.
Thank you. And Ms. O'Neill, what does the access to the rating analysts look like for you or someone from Eversource or Eversource representing AQUARION?
Are you asking how much contact I have with the rating analysts?
Yes, and the formality of it, so the frequency.
Sure, I'd be happy to answer that. I'm actually the primary person who maintains the relationship and the ongoing conversations with the rating analysts. We have one formal meeting with them in the spring. We also generally speak with them at EEI, which is a utility industry conference each November. It's a little bit less formal, but we meet with them in person. And I would say that do you want me to talk about Moody's specifically because AQUARION is only rated by Moody's, or do you want me to talk about all three?
I'd be happy to focus on Moody's for now.
Sure. So I would say that my contact, the rating analyst over at Moody's, I would say it's at least once a month. I would say right after our reviews, it's perhaps several times a week for several weeks until the reports are published. It's also if there is material information that's about to come out, we'll have a discussion. I actually have something on my agenda, not for AQUARION, but for another one of the Eversource companies on Mondays to speak with our Moody's analyst. So it's continuous.
I appreciate that. And when just from my clarity, when you say you mentioned reviews and then several times a week after the review, what does review refer to?
So we have an annual review where we sit down with several members of Moody's, and myself as party to that. The CFO, myself, and a few others as well. And we go through every single one of our companies that's rated by Moody's. We walk them through the forecast, and we also walk them through the qualitative items as well.
Thank you. And as part of those conversations, is it a back and forth, or is it a presentation and then you leave? Like, are there Q&A?
Okay, it's absolutely a back and forth. We do have a prepared presentation, but generally what happens is prior to the presentation, I will get a list of questions that they have. 99.9% of those questions have already been addressed in the presentation. And then there's also Q&A during the presentation and after the presentation.
Thank you. And does the company ever make adjustments to its forecasts or anything that's presented in there based following those conversations? Like, are you reacting to anything that Moody's says?
Yes, actually. We actually, in terms of, if I can just talk specifically about AQUARION of Connecticut, Water of Connecticut, once the merger happened, one of the advantages of the merger for Connecticut was the fact that, well, there were two advantages, but one of the advantages that they can now borrow from AQUARION Company, which borrows from Eversource through Eversource's commercial paper program, which is more than 100 basis points cheaper than how AQUARION Connecticut was borrowing prior to the merger. And during one of the conversations I had with Moody's is they had suggested that there was an Eversource revolver with different companies with different sublimits, and AQUARION Connecticut was not part of that sublimit. And Moody's had suggested, because AQUARION has its own debt, they would prefer that just as a backup, that there be a sublimit of AQUARION Connecticut within that revolver, and we did add $100 million sublimit.
Thank you. In these presentations and reviews that I have with Moody's, is there do you walk away with a mutual understanding about the risk profile, or specifically the to the extent that you're discussing forecasts or a rate case, for example, do you walk away with a mutual understanding about the likelihood of success at a regulator in achieving the full amount of a request, for example?
Well, I can talk specifically about this rate case. They certainly know what we've proposed. And they also, they know what the norm is in terms of, they know what Connecticut Water Company received, and they're expecting that we will receive the norm. And part of why they have us in this report that we spoke about yesterday, which is RRU 59, attachment 1, page 2 of 43, they talk about, factors that can lead to a downgrade, and one is a less constructive regulatory environment. And they also mention that right now they don't feel the regulatory environment is unfavorable. So because they did see what Connecticut Water Company received, and that plays a big role in what they expect the outcome to be in this case.
Thank you. Okay, I appreciate that. I have a few questions for Mr. Novak. So yesterday, and I believe it was in cross-examination in response to a question from our staff, you enumerated two things that need to be done if a company with a lower financial risk should receive a corresponding lower ROE. And I missed the first one, but the second one, I believe I understood you to say that there had to be a demonstration that investors factored in the lower financial risk. Does that sound commiserate to what you testified to yesterday?
Yes, and I believe the first factor would be related to a comparative analysis, whether it stood out from its peers.
Thank you. Does that mean the inverse is true?
The inverse with respect to?
A higher financial risk should receive a higher ROE, meaning that there needs to be a demonstration that investors factored that into their expectations.
Yes, again, it would go both ways.
Thank you. Have you consulted in any jurisdictions that use PIMs or performance incentive mechanisms for water utilities?
I have consulted in jurisdictions that use PIMs, performance incentive mechanisms, but I am not aware of whether or not they're used in the water utilities in those jurisdictions. I've consulted for companies that have used PIMs for either gas or electric utilities.
Thank you. I want to talk a little bit about the non-viable small water system premium adder that you discuss in your testimony. Specifically, I'm referring to your direct testimony at page, I want to say it was
51, I believe.
51. Yeah, thank you. Okay. So you make a reference to the Connecticut General Statutes section about non-economic viability. So for the purposes of this question, I'm going to assume that you reviewed that general statute section in full, but and let me know if that is not the case. My question is, do you have any specific knowledge about the difference in Connecticut constructs about non-economic viability versus an involuntary acquisition?
I'm not aware of a specific distinction between non-viability and involuntary.
Thank you. So you can't speak to whether the 4 systems that you've called out in your testimony were involuntary acquisitions.
I believe they were involuntary acquisitions, but I do believe that there were specific findings with respect to their economic viability.
Okay. Are you aware, or in crafting your recommendation on this subject matter, did you consult with the company as to whether they have an acquisition or growth target as part of their corporate goals?
I didn't consult with the company as to their prospective goals in looking at the prior precedent for this standard. I looked at if they had a historical track record of acquisitions.
Okay. Okay, I think those are my questions. Thank you. At this time, I'll ask Attorney Pace if you would like a moment to consider a redirect.
Yes, could I please have 5 minutes to speak outside the hearing room, my witnesses?
Very good.
Thank
So
you,
we will
Chairman.
recess for 5 minutes. Okay, I think we can go back on the record. Attorney Pace.
Yes, thank you, Chairman. I do have redirect examination that applies to the questions that were issued yesterday, as well as the questions that came in this morning on the cost of capital panel. I'm going to start first with my redirect examination of Ms. O'Neill.
Okay.
Ms. O'Neill, do you recall the questions you received yesterday from Mr. Novello of the Pura staff on the rating agency's reactions to AQUARION's earned ROE over the past 3 years, which was below the allowed ROE, and also the rating agency's awareness of the fact that the company has a robust future capital plan? Do you recall that line of inquiry yesterday?
Yes, I do.
And do you also recall that Mr. Novello had asked you, if these historical events did not result in a rating agency downgrade, doesn't it follow that Pura's denial of the company's proposed ROE and capital structure in this case similarly would not result in an agency downgrade? Do you recall that line of inquiry back and forth?
Yes, I do.
So my question for you is, do you agree with the premise that if historical events did not result in a rating agency downgrade, then Pura's denial of the company's proposed ROE and capital structure in this case will also not result in a rating agency downgrade? Do you agree with that premise?
No, I do not agree with that premise.
Can you elaborate?
I'd be happy to. First,
Is your mic on? I'm sorry. Thanks again.
I'd be happy to
Okay.
elaborate. First, we would have had trouble if we didn't file the rate case. The rating agencies look for cash flow as well as timely and adequate recovery of costs. So they are looking at the environment and the rate-making mechanisms to make judgments about cash flow and recovery. One of the reasons we are filing the rate case is because we were out of options and we need to improve cash flow and cost recovery. We were falling behind and the WICA mechanism can no longer be utilized because we had reached the cap. My colleague, Deb Szabo, has the answers to that. They expect us to obtain a ruling from PURA on the case that is consistent with the norm. When they have had that reasonable expectation, then they're less likely to institute a downgrade.
Okay, and you recall there were questions earlier today from the chairman that asked you questions about, Moody's assessment of the company's position. Are there any other reasons that a downgrade would occur where PURA has issued a decision with a low ROE and we have a debt-heavy capital structure? And to add to that, the company is currently under earning its allowed ROE.
Yes, we have to remember that the Moody's rating is 50% based on actually 40% based on financial metrics and 50% based on business profile / regulatory environment. So where PURA has issued a regulatory decision that is outside the norm, they will view that very seriously, incorporate that change in their decision making. When we under earn, and they know that we would file a rate case and obtain rate relief before things got so out of control that we'd have to act.
So do you recall yesterday, Mr. Novello had also asked you a series of questions regarding a report in the record prepared by Moody's. It was dated 2022, and I believe, subject to check, it was filed in data response QRRU 59, attachment 1. Do you recall that line of inquiry?
Yes, I do.
And do you recall that earlier this morning in your exchange with the chairman, you similarly referred to that Moody's report that's in RRU 59, attachment 1? Do you recall that line of inquiry?
Yes, I do.
Do you recall when the chairman asked you to identify some of the key metrics that the rating agencies look at, you identified the regulatory environment as being a key criteria?
Correct. Yes, I do.
And the Moody's report concluded that, and again, with these your words this morning, that the regulatory environment currently for water companies is reasonable. Was that your testimony this morning?
That is my testimony. That's in the Moody's report.
And how do you interpret that statement that was issued by the rating agency Moody's? What do you think they relied upon, or based on your knowledge, what did they rely upon in reaching that conclusion?
Okay, first of all, the Moody's report was issued on May 2022. So we have to look at what Moody's was looking at that time. They saw that the Connecticut water decision had come out in July of 21, and it was decided by the same commission. They saw that the Connecticut water decision was granted an ROE of 9% and that the capital structure was approved with no short-term debt. They also saw that the capital structure, the equity ratio was 52.73% and the debt ratio was 47.27%, which is comparable to AQUARION's actual capital structure. They also saw that AQUARION's last authorized ROE included a 50 basis point added to encourage acquisitions. And they saw that AQUARION has been completing those acquisitions as planned. So for Moody's, the regulatory environment for water companies is based on what they could see from this recent decision is constructive and very workable. If PURA now issues a decision for AQUARION, which is, in my opinion, a very good company with very high service quality that is out of the norm with a low ROE and a modified capital structure, Moody's perspective will change. Rating agencies are looking for regulatory environments that follow normal utility standards and grant fair decisions with timely and adequate recovery. And if Pure's decision substantially deviates from the norm, I believe there'll be a problem.
Okay, and going back to the exchange you had with the chairman this morning, where she inquired about the metrics that Moody's relies upon in reaching their ratings, do the rating agencies also take cash flow into consideration when they issue their ratings?
Yes, they do, and cash flow is part of the metrics.
Okay, and if Aquarion's ROE and capital structure fall below the norm that we've been discussing, what's the impact on the company's cash flow?
Negative.
And what impact could a negative cash flow have on Moody's rating of Aquarion?
It could move the outlook to negative, and if it was held long term, it could move the rating down.
Okay. In your exchange with the chairman this morning, when you were referring to its RIU 59 attachment 1, and you identified the metrics, and you mentioned that one of those metrics was FFO to debt. Can you just briefly explain what that means, FFO to debt?
FFO to debt is really sort of your normalized cash flow for the year divided by your debt outstanding.
And what's the trend in Aquarion's FFO to debt?
Well, the trend has been down, and I'll refer you to. It would be RRU 59, attachment. Attachment 1, page 3.
Okay, Ms. O'Neill, is there anything you want to mention from that page 3?
I do. From 2017 to now, the FFO to debt ratio for AQUARION has been declining. And given our capital spending level that is needed for the future, since the denominator, which is debt, is going up, we'll need the rate relief, which is the numerator, to also increase if we want to be able to keep our metric the same.
Okay, thank you, Ms. O'Neill. That concludes my redirect for you. I'd like to next move to Mr. Novak. And Mr. Novak, do you recall earlier this morning, Director Lopez from EOE had asked you questions about page 45 of your pre-filed testimony? Do you recall that exchange?
Yes, I do.
And do you further recall that during your exchange with Director Lopez, he asked about companies that include Consolidated Edison, Central Hudson, and Niagara Mohawk? Do you recall that exchange?
Yes, I do.
What was the purpose you were trying to communicate in your discussion of those companies at page 45 of your pre-filed testimony?
I think it's important to view the discussion on page 45 of my direct testimony in the context of the capital markets at the time. Mr. Lopez asked me several questions about subsequent ratings actions and ROEs that were authorized subsequent to that. It's also important to view when those decisions were derived and where the ROEs for these companies fell at that point in time. Again, we're exiting this period of 2020 and 2021 where we've seen record low capital costs. We have seen evidence of increases in capital costs since then. So recent decisions may have been viewed in a different light in the context of that those capital market conditions at the time of 20 to 21.
And just to clarify, there's nowhere on page 45 that you say that things have not changed at all in New York. Is that correct?
That's correct.
Is it correct, again, just to clarify, that the purpose for the discussion on page 45 was to illustrate that at that particular moment in time, based on the regulatory environment in New York, there was that cause and effect? Is that a true statement?
That's exactly right. And so much so that Moody's issued a specific report on the regulatory environment in New York at that time. Okay.
My final line of redirect examination, I'm going to ask you to recall the cross-examination conducted by Mr. Rothschild yesterday on behalf of EOE. Do you recall that during the exchange between yourself and Mr. Rothschild, he asked you if you had performed any analysis or testing on his CAPM analysis? Do you recall that exchange?
Yes, I do.
Do you recall that Mr. Rothschild further asked you, have you performed any other analyses or testing of the analysis provided in his pre-filed testimony? Do you recall that exchange?
Yes, I do.
And are there any other analyses you care to elaborate on at this time?
Yes, Mr. Rothschild asked me in particular about figure 10 of my rebuttal testimony to him. That's at page 34. And that was using several of Mr. Rothschild's assumptions, but looking at the difference in the different market return estimates that I saw throughout his testimony and work papers. In addition, I had also included figure 7, which looked at using a spot analysis at different points in time. That was also included in my rebuttal testimony at 25. Figure 8 was an elaboration of his work papers demonstrating the array of results based on different beta estimates that were used in his analysis. But in addition to the CAPM analyses, I also performed some sensitivities of his DCF analysis in light of the correction that he proposed, in which it produced what I would classify as a counterintuitive result, where the dividend yield increased, but the DCF result went down. Typically, we expect the dividend yield to increase we expect the DCF result to increase when we see an increase in the dividend yield. So I performed some sensitivities to his DCF analysis to test the reasonableness and isolating the effect of changes in stock price on his sustainable growth DCF method. And typically what you expect to see in a DCF model is when the stock price of a particular company goes up, the cost of equity goes down, all else equal. On the flip side, if the stock price goes down, you expect the cost of capital to go up. But what I found was when I performed a sensitivity where I just changed the stock prices, looking at different levels of increases or decreases. When I decreased the price, I saw the cost of equity go down, as one might expect. But when I increased the stock price at levels of 10%, 30%, 50%, 100%, they all produced a result that suggested the cost of equity increased. And this really defies the economic logic that underpins the DCF model. So I found that somewhat troubling.
Okay, thank you, Mr. Novak, for that clarification and that analysis. My final question is going to ask you to recall the series of questions you received that inquired about the methodology that you used in both your direct testimony and in your rebuttal testimony. You received a number of questions over a series of hours yesterday. Can you explain in your methodology what adjustment you make for flotation costs?
Sure. Importantly, my analysis considered both DCF and the CAPM primarily. I use the expected earnings model as a benchmark analysis, but I also included an adjustment for the acquisition of non-viable water systems and flotation costs. And flotation costs are an important consideration because these are costs that are directly incurred by the company to issue equity. And if they aren't accounted for in the ROE, they are not recovered. And these are necessary costs for raising capital for the company. And my recommendation is consistent with the calculation methodology that was used by Connecticut Water in their recent case, in which they were awarded a flotation cost adjustment of 15 basis points. My calculation for AQUARION is 7 basis points.
Okay, thank you very much, Chairman, for the latitude to conduct a redirect examination. That completes my redirect.
Thank you. And thank you to the witnesses. We have concluded this panel, and I believe that is the last company panel. So the company's witnesses are excused until the late file exhibit hearing. So at this time, we're going to commence with the OCC's panel on the same topic. So I would ask the OCC witness counsel and counsel to approach and ask the company's counsel to take up the table over here for cross, please. Attorney Pace, will the company be pulling up exhibits? Okay. Got Mr. Bumpin on stand.
Yes, Chairman, just to clarify, Mr. O'Malley from AQUARION is going to be calling up the exhibits. I know he did provide a flash drive to the case coordinator.
Okay,
Thank you very much. If we could just have a moment while we get settled. Thank you very much.
sure. While we get that set up, I can swear in the witness. If you can introduce your witness, please.
Certainly, Madam Chair. This is Dr. Randall Woolridge, the OCC's cost of capital witness.
Dr. Woolridge, if I could administer the oath, I just ask you to raise your right hand. I swear to tell the truth, the whole truth, and nothing but the truth under pains and penalties of perjury.
I do.
Thank you, sir. Attorney Wheel, if you'd like any pre-filed materials adopted.
Yes, thank you. Dr. Woolridge, could you spell and spell your name for the record, please?
My name is the initial J, Randall Woolridge, and that's spelled Woolridge.
Could you just check to make sure the light is on that microphone? There's a gray button. There we go. Oh, there, it's on now. Thank you.
Okay, sorry.
Did the court reporter need him to repeat that? Or, okay, thank you. And were you retained by the Office of Consumer Counsel as a consultant in this case?
Yes,
Did you sponsor any pre-filed testimony or interrogatory responses filed in this matter?
yes, both.
And do you wish to highlight any corrections to any of those materials at this time?
There's just one correction, I think, in the testimony on exhibit JRW 5.
Could you,
Page 6 of 6. There's a table there that summarizes the different growth rates indicators. For the proxy group, the first two they're correct in the exhibits and the testimony, but on this table, they're incorrect. The historic value line growth in earnings per share, dividend per share, book value per share, that number is listed at 5.8%. That number should be 6.2%.
thank you. So that's just for clarification, that's that first line, the first 5.8% that appears on that table.
Yes,
And the corrected number there should be 6.2.
6.2. And the second edit is the 5.8% that's right below that for the projected growth rates. Instead of being 5.8%, it should be 5.9%.
Okay, so the first two boxes in that column should read 6.2 and 5.9% rather than 5.8 and 5.8%.
Yes.
Thank you. Do you have any further corrections to any
No.
of the materials? And with that, do you adopt those materials with those corrections as your sworn testimony today?
I do.
And the witness is available for cross-examination.
Thank you. Before we start cross, let me just, is our case coordinator, is Miss Lewis in the room? No. Okay, all right. Well, I guess Mr. Bumpin will have to assist. Is Mr. O'Malley, Mr. O'Malley, are you all set up? Okay, very good. Well, I'll just have to make sure that Mr. Bumpin keeps us on the live stream. Thank you. Okay, let us begin with our cross-examination for this panel. And first up, we have the company.
Thank you, Madam Chair. And good morning, Dr. Woolridge.
Good morning.
My name is Robert Hum. I'm an attorney for AQUARION Water Company of Connecticut. So let's start on page 15 of your direct testimony at lines 15 through 16.
Yes.
And there you indicate that authorized ROEs reached an all-time low, correct?
Yes.
And on the next page, page 16, at lines 4 through 6 of your testimony, you indicate that the average ROE for water utilities in 2020 was 9.04%, correct?
Yes.
Are you aware that the six cases listed by RRA include a case for blue granite water in which the authorized ROE included a penalty for service quality?
I do. You're correct. I think Mr. Rothschild was the ROE witness in that case, but yes. I do, yeah, that was part of it, yes.
Thank you. And are you aware that Mr. Novak submitted rebuttal testimony in this case to Mr. Rothschild, who you just mentioned, and that's at exhibit B-8-JCN-1?
Yes,
Even though Dr. Woolridge, that wasn't to your testimony, have you reviewed Mr. Novak's rebuttal testimony to Mr. Woolridge?
to me, or,
I'm sorry, to Mr. Rothschild.
no, I really haven't. I mean, I looked at it, parts of it, but not the whole thing.
Okay, thank you. I'm just going to pull it up on the screen just as a reference point, and then I'll move on past that. And again, I think that's exhibit B-8-JCN-1. In just a moment. Thank you for your patience. Okay, great. Thank you. And so this is Mr. Novak's rebuttal testimony to Mr. Rothschild. And we're going to turn to page 5 at footnote 4 of this rebuttal testimony. There in footnote 4, are you able to see that, Dr. Woolridge?
I can see that, yes.
So in this footnote, it indicates that the South Carolina Public Service Commission noted in its decision that the return on equity was determined, quote, in considering the quality of service issues known to exist with Blue Granite and the setting of just and reasonable rates, correct?
Yes.
Subject to check, would you accept that the average ROE for the 5 cases in 2020 that excludes the Blue Granite decision was 9.36%?
I would, yeah. RRA, I think, published that someplace too. Yes, I agree.
Great, thank you. Now, staying on page 16 of your testimony at line 6, you indicate that the average ROE for water utilities in 2021 was 9.46%, correct?
Yes.
Over the period of 2020 to 2021, treasuries were at historic lows, correct?
They were.
And do you agree that the average 30-year treasury yield was 2.05% in 2021?
I do that analysis in table 3. And in 2021, I had an average, I took the average daily yield for a 30-year treasury, so it was 2.06%.
Thank you. Okay, well, thank you for that correction. And do you agree that the average 30-year treasury yield from that table 3 is 1.56% in 2020?
Yes.
And the 30-year treasury yield has increased at least 150 basis points since those 2020 to 2021 average levels, correct?
I agree, yes.
And the 30-year treasury yield has been 3.55% or higher since September 2022, correct?
I believe you're correct there. Yeah. And I talk about this in my testimony where I say, yeah, interest rates went way down, ROEs did not go way down. I discussed this on this couple of pages. In other words, when obviously interest rates went from 3% or so to 1.5%, down about 150 basis points. Authorized ROEs only went down about 20 basis points. So, they never went down as low. And so as their interest rates are going up, ROEs will go up at some point, I believe, but it's not like they didn't go down like interest rates did.
Okay, thank you. Now, have you reviewed Mr. Novak's rebuttal testimony to your testimony? which he has at Exhibit C-8-JCN-1?
I have.
And if you could please turn to that rebuttal testimony at page 8 and specifically figure 2.
Yes,
And do you see the distribution of authorized ROEs since Aquarion's last ROE decision in Connecticut?
I do.
In the Connecticut water decision of 9.00% is highlighted as a bullet in figure 2, correct?
Yes, it is.
And you submitted testimony in that proceeding, correct?
I did.
And subject to check, would you agree that your recommendation was 8.70% in that case?
Yes, I agree.
And the 30-year treasury yield at the time that case was decided was less than 2%, correct?
It was, yes, I agree it was.
And again, the 30-year treasury yield has been 3.55% or higher since September 2022, as we just discussed, which is more than 155 basis points higher than when the Connecticut water decision was issued, correct?
Exactly, yes. Well, I agree, and that's what I talk about in my testimony. It's fallen off. Authorized ROEs never fell off like interest rates. So now interest rates are going up. At some point, ROEs will probably go up again, but it's a matter of what the data suggests. And so I agree. I mean, we've seen interest rates bounce up, but they've declined. You know, yesterday the Wall Street Journal highlighted that interest rates declined. I mean, from 4.2% to 3.5% on the 10-year. So, I mean, I agree. They're higher, but they've been higher. Now they've come down some.
Okay, thank you. Now, in the past, PURA has taken into account changes in the 30-year treasury bond yields when setting an ROE for a utility, correct?
I believe they have. I don't recall all the orders, but I remember seeing certain templates that PURA used where they had GDP, interest rates, inflation, and a lot of things, but I haven't seen one of those in a long time.
It subject to check, or are you aware that PURA has taken that into account in the Connecticut water decision at docket 20-12-30?
I believe they might have, yes, but because I've seen that template before.
Okay, thanks. Now, based on the distribution of returns in the figure 2 that's in Mr. Novak's rebuttal testimony we were just looking at, would you accept, subject to check, that your recommendation of 9.00% is below 90% of the authorized ROEs for water utilities over that period?
Yes, I believe so. And I again, in my testimony, I highlight the recent Wall Street Journal study that showed that over time, authorized ROE has been higher than other indicators would suggest, and it's been a long-term phenomenon. And I discussed that study in my testimony at it's discussed on pages 19 through 21. Just that historically, somebody went back and looked at every authorized return decision in the last 50 years to see kind of what's happened. They found that on a real basis, the numbers haven't changed much. They've been pretty thick. But they also say, we look at these 6 indicators of what's happened to equity cost rates. They've all gone down and equity cost rates didn't go down. So this was just a study. It was highlighted in the journal, but I believe it's true. I think that's I've said that in my testimony for years, that especially on the way down, commissions will go ahead and when interest rates go up, or commissions will jump and increase rates, but when interest rates go down, they don't reduce ROE. So it was highlighted in that study.
Okay. Now, in selecting your ROE recommendation, you selected the top end of your range, correct?
I did. And at that time, when I filed my testimony, the 20-year treasury was at 4.5%. Well, it's down to 3. And that was part of, it was the high end of the range because interest rates had really spiked then. Well, they've fallen 75 basis points since then.
Now, when you selected your ROE recommendation, you did not make any adjustments to your recommendation based on the company's risk profile relative to the proxy group, correct?
I didn't make any explicit adjustment. You're correct. And But I did pick the range because of what happened to interest rates at the time. I don't know now if, I mean, you know, if I redid my CAP-M, I would have a much lower interest rate, but I'd have a higher market risk premium. But if I redid it today, I think it would be 8.6%, not 9.1%.
Now let's talk about your discounted cash flow model. So referring to your direct testimony at page 69, lines 19 through 21, you indicate that you primarily relied on your DCF model, and given the recent increase in interest rates, you used the top end of your range in making a recommendation of 9.0%, as we just discussed, correct?
Yes. I'm sorry, I can't find that. What?
Yep. I believe it was page 69 of your testimony at lines 19 through 21, but we can double check that.
Okay, yes.
Now, referring to exhibit JRW-5, page 1. Your DCF analysis is based on a dividend yield component of 2.4% and a growth rate of 6.5%, correct?
Yes.
Now, referring to the next page of exhibit JRW-5, which is page 2, dividend yields are calculated based on the annual dividend displayed in the exhibit, correct?
Yes.
Now, if we can turn back to Mr. Novak's rebuttal testimony to yours, and specifically exhibit C-8-JCN-8.
Yes.
And in that exhibit, Mr. Novak demonstrates that the annual dividends displayed in that exhibit JRW-5 at page 2 are based on dividends as of March 2021, correct?
I don't recall that being the exact date, but no, I don't.
Is that something, Madam Chair, we can pull up on the screen? Mr. Novak's exhibit C-8-JCN-8.
Is that what's up?
I think it might be what's up there already.
Okay.
It's up there. Yeah.
We're
Thanks.
having a little bit of technical difficulties today.
Okay, thank you. And if we can maybe scroll in a little bit, just so we can see the numbers and follow along. Okay, thank you. You can see in that box,
Yeah.
it's the second box technically, but the box that's in the middle of the table has the annual dividends as presented in exhibit JRW-5, page 2, correct?
Yes.
And if you scroll down to the next box,
Yes.
we see that same column on the left side where the numbers are. Those are the same numbers as exhibit JRW-5, page 2.
Yes, they are.
And those are dated March of 2021, correct?
They are.
And the column that's to the right of that is a column of annual dividends dated October 2022.
They're a little higher. That's correct. Yes.
Thank you. And do you agree with Mr. Novak's assessment in terms of that comparison he's made there?
I haven't seen what the overall impact is on the dividends.
Okay.
I haven't seen the overall impact on the yields.
Okay.
It's a little higher. Yes. They're about 20 basis points higher.
Okay. And so is there any reason to use the March 2021 dividends with the October 2022 prices as part of your DCF estimate?
No, that's probably that. You know, my dividend yield should probably be 20 basis points higher.
Okay, thank you. Now, if you can please turn to page 74 of your direct testimony.
Yes.
And There you criticize Mr. Novak's exclusion of the DCF result of Middlesex water, correct?
Yes.
Would you agree that generally it is not logical for an investor to purchase the stock of a utility company if the return on the utility stock is lower than the yield on the utility bond?
Yeah, my concern about that is not about, it's more about the methodology. In other words, that when there's error, in statistics, there's a thing called errors in the variables. So when you're estimating in the case of DCF equity cost rates, the dividend yield and the growth rate, okay? And there's error. We measure all those with error. And as a result, the way you deal with that is put together a group. And you don't exclude one or another. You just say, these errors are going to average out if you average a group. And that's why you always use a group in any type of valuation analysis or anything like that. So my concern isn't what the number is. It's that, we're averaging these together in a group because these things are measured with error. So when you do that, that's how you read statistics called errors in the variables. And it's the way you deal with it is use a group.
Okay. Now, Pura has adopted a screening practice to exclude implausibly low ROEs when calculating the DCF, correct?
They have used it in the past. I don't recall what it is now.
And are you aware of whether Pura used that approach in the Connecticut water case?
I don't recall.
Okay, thank you.
But again, my concern with that is that the statistical thing. Well, we're going to exclude some of them where the reason we use a group and average the group is to average out the individual company errors. So I would just say I would not agree with that because of that statistical problem.
Okay. Now let's refer back to exhibit JRW-5 and specifically page 1.
Yes.
And we talked about a few minutes ago that your DCF analysis is based on a growth rate of 6.5%, correct?
Yes.
And the summary of growth rate indicators is provided in that exhibit JRW-5 at page 6, correct?
Yes, that's correct. Those are the numbers I just corrected.
Okay. So the first line in that table, which is one of your corrections, is the historic value line growth in EPS, DPS, and BVPS, correct?
Yes.
And there, the underlying estimates simply reflect the historical performance for the proxy companies, correct?
Yes.
And as you've corrected the estimate here of 6.2%, that would be 30 basis points below your estimated growth rate, correct?
Yes.
And just for reference, by EPS, DPS, and BVPS, you mean earnings per share, dividends per share, and book value per share, correct?
Yes.
When analysts are developing forecast estimates for EPS, DPS, and BVPS, do they take into account historical performance?
Well, I think investors do, but I haven't given a lot of weight to historical numbers. But the reason is 95% of the information investors get, at least 95%, are historical numbers, whether they're income statement, balance sheets, investor reports, that sort of thing. So, obviously, they're viewed there for a reason. They must have value to investors, so it has something to do with creating their expectation. But I don't give the historic numbers a lot of weight.
Okay. Now, the next line, that's the other one that you corrected. That's for the projected value line growth in EPS, DPS, and BVPS, correct?
Yes.
And these estimates are all provided by value line. And that's why there's the reference to value line there, correct?
Yes.
And this estimate in the second line is now 5.9%, and that's 60 basis points below your estimated growth rate, correct?
Yes.
And these values represent forecasts, correct?
They do.
And again, this estimate is provided by a value line analyst, correct?
Yes.
And specifically for each proxy group company, the estimate of EPS, DPS, and BVPS is provided by a single value line analyst, correct?
Yes.
So this is not a consensus estimate, correct?
No, I mean, I think in a way, they are, yeah, they're using the value line system. Everybody's trained a value line to use their system. And as I cited in my testimony, I mean, the studies I've seen on value line forecasts is they are incredibly over optimistic, I think is the terminology the author used. So yeah, you're right. It's one analyst, but it's using the value line system, the way they're trained, the models they use, that sort of thing.
Okay, and actually, in fact, the terms, the over optimistic, I think that's on page 51 at lines 6 through 7 of your direct testimony, correct?
Yes.
Now, is there any reason to believe that EPS would be more over optimistic than DPS or BVPS?
I'm trying to remember the study, but they found that they were overly optimistic on several factors. I don't know if it was only earnings.
Now, staying back on exhibit JRW-5 at page 6, the third line in the table refers to sustainable growth, ROE, multiplied by retention rate, correct?
Yes.
And were those calculations all based on estimates that are provided by Value Line as well?
Yes.
And this estimate here of 4.4% is 210 basis points below your estimated growth rate, correct?
Correct. Yes.
Now, referring to that fourth line in that same table, that includes projected EPS growth from Yahoo, Zacks, and S&P Capital IQ dash median, correct?
Yes.
And the estimate there of 6.6%/6.4%, that's consistent with your estimated growth rate of 6.5%, correct?
I believe so, yes.
Now, referring to page 53 of your direct testimony,
Can you tell me, somehow my version has different pages, so you tell me what the discussion is, I'll find it.
Sure. So page 53 of your direct testimony, there's a statement on lines 18 through 19, which states, giving primary weight to the projected EPS growth rate of Wall Street analysts, correct?
Yes. Oh, yes, I do. Okay, I found it. Thank you.
So now that you find it, we're going to go back a couple pages to page 51.
Yes.
So on lines 19 through 20 on page 51 of your testimony, you state the growth rate needs to be adjusted downward from the projected EPS growth rate to reflect upward bias, correct?
Yes.
Now, when you say that here in your testimony, where did you make that adjustment in selecting your growth rate of 6.5%?
Well, two things. First of all, the highest number is 6.6%. Okay. So there's a slight adjustment. And second of all, as I said before, I picked the high end of things because of the high interest rates at the time. They've really come down. I haven't updated this, but anyhow, that's why I did it. I mean, there's two reasons. One, it was slightly below the mean, but it's also with interest rates really peaking at the time, I went with the high end of the range.
Okay. Now referring to page 66, page 76 and on to page 77 of your testimony. And there you cite an article from McKinsey and Company that was published in the spring of 2010, correct?
Somehow my pages got screwed up. Yes, that is true.
And this article states that the actual earnings S&P 500 companies report coincided with the analyst's forecast from 2003 through 2006, correct?
Yes,
And you're aware that the global analyst research settlement was adopted in 2003, correct?
yes,
And since the 2003 settlement, the article you cited only reviewed the years 2003 through 2008, correct?
yes.
Have you produced any documentation in this proceeding proving out your theory that there was an upward bias in relation to specifically water utilities or to the proxy group that you used?
Well, if you go to page 50, I have results of a study that I have done about electric utilities and gas distribution companies. And I show that over the 30-some year period that the average forecast is about, on average, 200 basis points above the actual growth rate. So it's for regulated utilities, it's electric and gas. There were no water companies in this study.
Okay, thank you.
So they're regulated utilities.
Okay. Now let's move on to your capital asset pricing model, or the CAPM. Would you agree that Value Line is a source that is widely available to investors and commonly used by investors?
I believe so, yes.
And it is also widely used in regulatory proceedings, correct?
Yes, I agree.
And are you aware that Value Line reports beta coefficients?
I am.
And in fact, you've relied on Value Line as your source of beta coefficients, correct?
I have.
Does Value Line report any option implied betas?
Not that I'm aware of.
And does Value Line report any forward betas of any kind?
No, they have different years, 1 year, 5 year, 10 year. No, maybe not 10 year, 1 year, 3 year, 5 year. But no, they don't have anything projected.
And you were aware that Yahoo Finance, Bloomberg, Google Finance, Reuters, Morningstar, Capital IQ, MarketWatch, and CompuStat all report beta coefficients, correct?
Yes.
And do any of these sources report option implied betas?
I don't know.
Do any of these sources report forward betas in any manner?
I don't know.
And have you ever relied on option implied betas or forward betas of any kind?
No.
Okay, thank you. I have no further questions at this time.
Thank you. That completes the company's cross-examination.
It does, thank you.
Very good, thank you. All right. All right, very good. Attorney Marshall does deep BET. Thank you. Attorney Wright. Thank you, sir. Attorney, Director Lopez. Thank you. Then I will ask Pura staff to approach Mr. Novello, please. Okay, Mr. Novello, when you are ready.
Thank you. Good afternoon.
Morning.
Morning, sorry. Good morning.
Morning.
Just a couple of questions for you today, Mr. Roach, Dr. Roach, sorry. One on Aquarion's risk profile. And Mr. Novak's rebuttal, he stipulates in your analysis that your analysis fails to demonstrate that Aquarion's risk profile is lower than other water utilities and thus requires a higher ROE than your recommendation. Is that correct?
What's that? I didn't.
That in his rebuttal that Mr. Nowak stipulates that Aquarion requires a higher ROE than your recommendation.
Where? I don't know what you're talking about.
Okay. Well, how about generally? Do you think that Aquarion's risk profile merits the higher recommended ROE as proposed by Mr. Novak?
No, as I say in my testimony, I think it's in line with other water companies.
Okay. That was the next question. And you feel it's in line with the other risk companies. In Mr. Nowak's rebuttal testimony on page 6, he points out that interest rates are now higher than the last 2 years and higher when Aquarion held its last rate case. You agree with that?
I haven't looked at the numbers, so I don't remember. I don't know if that's true or not.
Okay. And do you think that higher interest rates alone would justify a higher ROE for a regulated water company?
Well, I discussed this in my testimony and I mentioned it earlier. I've done this study. I mean, obviously interest rates went way down during the pandemic, have come back up. But I think the issue was, interest rates went down 150 basis points, ROEs went down 20 basis points. So interest rates have come up, and I'm sure ROEs will go up at some point. But the bottom line is, you have to look at the time frame and that sort of thing, and consider other factors when you look at the relationship between ROEs and interest rates.
Okay, thank you. Referencing your pre-filed direct testimony, pages 16 and 17. You identify, hold on, I'll let you get there.
Go ahead.
You identified the ROEs for the water, electric, and gas from 2007 to 2022, and summarized the average return for water utility cases. You mentioned these record low ROEs were at these levels due to low interest rates and low capital costs, correct?
Yes.
And now some of these capital costs have increased?
Yes.
But that doesn't correlate directly to higher ROEs.
Well, it doesn't necessarily because of the one reason they never declined that much. But obviously, it depends to some degree. I think one thing that if you look at like DCF numbers, obviously the utilities haven't been impacted nearly as much as the overall market in terms of the decline. And I think I put that on page 14 of my testimony. So their dividend yields haven't jumped as much, and so DCF equity cost rates haven't jumped as much.
Okay, thank you. And a couple of questions on your market risk premium. The sources that you use for your market risk premium, such as Duff and Phelps, KPMG, Fernandez, Demidarian, these are widely accepted estimates for market risk premium, correct?
Well, they're pretty much, if you Google equity or market risk premium, what's going to come up? The sources I said, Demodern, Duff and Phelps, KPMG, yeah.
Okay.
Just they're pretty well-known sources.
Okay, and in your analysis, you mentioned Mr. Novak's analysis. His methodology uses a expected market return of 12.37%, and you feel that's excessive for the S&P?
Yes.
Okay.
A big part of that, as I explained, is the way you compute the expected market return, dividend yield plus growth rate, where the growth rate are analyst growth rate figures.
Okay.
And I show in my testimony, you can't grow, earnings at, I forget the number, the exact number. I looked at his FERC study, but it turns out he had earnings growing at 10.59% forever. And I show and I cite, Warren Buffett and others that over time, the economy and earnings growth rates are about the same. I show historically it has, but I also cite Buffett and others that say, look, earnings are they're about 6% of GDP, and they're not going to grow to 25%. And so I demonstrate that if earnings grow at 10.59%, the economy grows at 4.5%, earnings are going to be out of line with the economy. It ain't going to happen.
Okay, thank you. Would you agree with the assertion made by Mr. Rothschild that if all else is held constant, the higher the equity percentage in a capital structure, the financial risk profile for the company is reduced as it relates to the credit rating agencies?
Yes.
Okay. And in your analysis, you conclude that a capitalization mix should include short-term debt.
I do, yes.
And why did you arrive at that conclusion?
Well, I looked at their history of their capitalization.
Okay. And do you normally include short-term debt in your?
I do if the company uses it.
Okay. And just a couple of questions on the expected earnings approach. What does that actually measure, the expected earnings approach method?
Well, the way it's used is, you look at the expected returns on equity for, say your proxy group or similar companies and that sort of thing. And, I explained that, there's a lot, it doesn't relate to a lot of other indicators of equity cost rates. It's an accounting measure. It's based on book value, that sort of thing.
Okay. And you don't believe that the expected earnings approach measures the cost of capital, or?
No, I don't. I mean, I cite Dr. Morin's book on this topic. I was in a case, 2 years ago, Dr. Morin, he talks about the expected earnings approach, but when he testifies, he doesn't use it.
Okay. And that's all I have. I just have one clarifying question from the testimony earlier. You said if you were to redo your CAPM model, you would reduce the risk-free rate in the current model than the prior model that you used, but you would also increase the market risk premium.
Yeah, and I think, what I would do if I was redoing it today, given 6 weeks ago, like Duff and Phelps increased their market risk premium to 6%. I would use a 6% market risk premium, but the 20-year Treasury's gone down by 75 basis points. Today it's 3.8%. So you put 3.8% as the risk-free rate, 0.8 as the beta, 6% as the market risk premium, you get 8.6%.
Okay. And referring to the beta coefficient, is it higher on average now than it has been?
What's that?
The beta coefficient.
Well, I cite that in my testimony. I have a table, and I think it's significant. They are higher, but at the same time, they have the utility betas are higher, but they're still among the lowest betas. So I'm looking at page 37, and there's 93 industries there, I think, and the natural gas and water and electric are all in the bottom 10%.
Okay. Thank you very much. That's all I have, Madam Chair.
Thank you. We will turn to questions from the bench. Commissioner Karen.
No question.
Thank you, Mr. Vice Chairman.
No question, Madam Chair.
Very good. I have just a handful. Dr. Woolridge, are you generally familiar with Aquarion's current access to the revenue decoupling mechanism known as RAM, the earnings sharing mechanism, and WICA? You're generally familiar that Aquarion has access to all three. Okay. Did the assumption that the company would retain access to all three mechanisms, I'll call them, factor into your analysis in any way?
Well, just a general risk assessment, and generally that a lot of these utilities generally have these now. So you compare one utility to another, they have various mechanisms. Thing is, they're all different. Whether they're adjusting revenues, expenses, that sort of thing. So it's tough to make an apples to apples comparison. You just look at the general risk profile with the credit rating. I do, just because it's tough to make adjustments for each and every one of these different mechanisms.
Okay. Generally speaking, do you think the access to these mechanisms combine to make the company less risky or more risky?
I think it clearly makes it less risky. The question is it less risky relative to the proxy group?
Thank you. What do you think generally speaking, what is your view on the purpose of an ROE adder or conversely an ROE reduction?
Well, I mean, you see these occasionally. In my analysis, I assume there's no reason. I'm trying to find the required rate of return, and that doesn't include adders and that sort of thing. So I generally feel that that's more of an administrative decision, not something that an economist should provide a basis for. You know, on the rider for the acquisitions, I mean, obviously the company's going to pick up new customers and rate base, so their revenues are going to go up. Does that mean their existing customers should pay higher rates or a higher ROE so that they can acquire other water companies?
Okay, thank you. So the ROE adder that is built into the current rate base of Aquarion, that's been in effect since their last rate case, to your knowledge?
Well, I'm not familiar specifically, but I knew they had that type of rider in that case.
Okay. What is the directional impact on rates of including an adder?
Well, I think the big thing is there's a risk transfer from the company to their customers. So whether they have to make adjustments for one thing or another, effectively customers are going to pay that. The company's not. It's going to be built into rates.
Okay. Okay. All right. Thank you. I think those are my questions. So I will ask your attorneys if you need a moment to consider redirect.
Can we have 5 minutes, please?
Yes, we will recess for 5 minutes. Please be seated. Okay, I'm going to go back on the record and Attorney Beal, any redirect?
Thank you for the time. The OCC does not have redirect for this witness.
Okay, very good. Thank you. So it is 11:47. Let me do this. Would any party object to a roughly 45-minute lunch break so we can resume at 12:30? There are objections? Okay, so let's break and we will commence with our final panel at 12:30. And first step when we get in, we'll have the company at the cross-examination table and we can get our EOE panel set up. So we will reconvene at 12:30.
And Madam Chair, just for clarification, is Dr. Woolridge dismissed?
Yes, I apologize. Dr. Woolridge, you are excused until the late fog debate hearing. Yes.
Thank you.
Thanks. Thank you. Who's coming? Yes, he is. Rob. Oh, yes. Okay, this can stay.
I know it's cold in here today.
Yes.
Yes, I am.
Yes. Oh, almost made it up. Let me make sure that all works out. Yeah, no, I changed the lunch break screen. The problem is that like, the problem isn't like screen sharing onto YouTube, screen sharing into the room. You know, like someone will pull up like testimony to broadcast, right? You see it on YouTube, so people watch on YouTube, see it in the room. It's not coming on the TV in the room. Yeah. Yeah. But the problem is to get it to show in the room, you have to turn self-view off. But self-view is the broadcast of the room, which is why it's flat on YouTube while they're talking. I'm trying to figure it out, but I can't. Thanks.
Yeah, absolutely. Okay, we're still getting set up, but Director Lopez, you guys can approach whenever. Oh, I thought you forgot your pen again.
No, I left it here.
These are definitely staying here. Two open drinks and a big thing of water. I thought I had brought that one upstairs. I don't know. I need to be hydrated at all times. You ready? Okay, very good. Okay, welcome back from the lunch break. We are going to get started here with our final panel. So Attorney White or Wyman, whomever would like to introduce the witness so I can swear him in.
Mr. Rothschild, please state and spell your name for the record.
My name is Aaron.
Oh, green button.
My name is Aaron Rothschild, AARON, and ROTHSCHILD.
Okay, thank you. And for the benefit of our court reporter, my name is Kimberly White with EOE, and this is Brittany Wyman with EOE.
Thank you. Mr. Rothschild, if I can administer the oath, please. If you can raise your right hand. I swear to tell the truth, the whole truth, and nothing but the truth under pains and penalties of perjury.
I do.
Thank you. And Attorney White, if you'd like your witness to adopt any pre-filed materials, please.
Mr. Rothschild, were you retained by EOE to provide expert testimony in this proceeding?
Yes, I was.
And other than the updates already submitted into the docket on November 30th, do you have any corrections to the testimony that you provided?
I do not.
Do you adopt that testimony at this time?
I do.
The witness is available for cross-examination.
Thank you. So we'll begin cross-examination of this witness with the company. And I'll just say to the company, if you do indeed need the full 2.5 hours, I may cut you off for a break after the 2-hour mark. Okay. Thank you.
Understood. Thank you. Oh, good afternoon, Mr. Rothschild.
Good afternoon.
My name is Robert Hum, and I'm an attorney for AQUARION Water Company of Connecticut. So let's start with your direct testimony at page 3, lines 10 through 15.
Okay.
And there you quote the U.S. Supreme Court case, Federal Power Commission versus Hope Natural Gas Company, 320 U.S. 591, page 603 from 1944, for the principle that the return to the equity owner should be commensurate with the returns on investments in other enterprises having corresponding risks, correct?
Correct.
And your proxy group was not selected to include companies in other enterprises having corresponding risks, correct?
And my proxy group was not chosen?
That's right. That's how the question is phrased.
It was chosen to be similar in risk to Aquarian. It was, yes. My 3 proxy groups were chosen to help with the process of fulfilling the standard of the Supreme Court.
Now, for proxy company regulated operations, each regulated company has an authorized rate of return set by a public utility commission, correct?
Yes.
For regulated companies, the authorized rate of return is a key financial term that is important to investors and credit rating agencies, correct?
Yes.
And your 8.33% return on equity recommendation is derived using data from your RFC water proxy group, correct?
Yes.
If you can please turn to pages 20 to 21 of your direct testimony. And as support for your recommendation, you cite to the authorized ROEs for 4 utilities, correct?
Yes.
Are any of these companies in the RFC water proxy group?
No.
Have any of the water utilities owned by the companies in the RFC water proxy group ever been authorized an ROE as low as 8.33%?
Not that I'm aware of.
Now, please turn to page 10 of your direct testimony.
Yeah.
And in referring to table 2, you state that the range and midpoint of your recommendation are set by the outer 96th percentile range, correct? Oh, I'm sorry, 69th percentile range. Sorry about that. And I can restate the question if that was confusing.
And where do you see the 69%?
Sure. So looking at that table 2, the second to last line in the table refers to the outer 69th percentile range, and it has a low and a high number there, correct?
That's correct.
Now, referring to that footnote 6 that's on page 10, you state that your preferred approach is to use an outer 75th percentile range, except when this approach results in a range that is too wide, correct?
Yes.
And you further state that you use the higher percentiles to eliminate values from both ends with the aim of arriving at a central range with a width of no more than 120 basis points, correct?
Yeah, yes, that's correct.
The width of the range that you've derived here in table 2 is between 7.76% and 8.91%, which is 115 basis points using the 69th percentile, correct?
Yes.
And what would the range be at the 75th percentile?
I don't have that. I don't have the calculation right here. It would be a little wider.
So is it your testimony then that you made an adjustment to the range derived from your methodologies because it was too wide, but you don't remember what the 120th basis points would be?
Or what it would be if I use the 75th percentile?
Correct.
I think I can calculate that for you. It would be 719 to 908, and my cost of equity recommendation would be 813 instead of the 828.
Now, can you cite to any other testimony that you've ever submitted on return on equity using the 69th percentile to pick the midpoint of the ROE range resulting from your methodologies?
I don't, as I was mentioning, I try to shoot for that 100 to about 120 basis point spread. So I've used, I don't remember, recently I've used 75, or in other cases a little lower. I don't recall exactly, but I'd be surprised if I used exactly 69 in any other cases.
So just going on memory, you don't recall whether you've used the 69th percentile range before, correct?
I do not, no.
Now, in this case, did you try different numbers besides the 69th percentile, such as the 71st percentile, 72nd percentile, to see what that would do to the range?
I don't recall exactly which sensitivities that I did, but as I was mentioning, I was shooting for about what shows is about 100, it's 115 basis points. Yeah.
And with the range here being the 7.76% to the 8.91% at the 115 basis points, what would it be at the 120 basis points?
If it was exactly 120 basis point spread?
Correct.
It would take some time to iterate to try. I don't know if I want to, if it'd be good to spend the time here, but that's certainly.
Is that something that, if given the time, you think you could provide?
Yes.
So in response to that, Madam Chair, we'd like to request, with your permission, a late file.
Okay, so that would be late file exhibit request 77, and the request is made to EOE to provide, are you looking for them to reproduce table 2? What's their request exactly, please?
Yeah, thank you. So I think the request, and if it's within table 2, that would make sense. The request would be what the range would be at 120 basis points.
Okay.
Just earlier, I provided what the results would be if I changed it to the 75th percentile. I would like to give you another number because I used that with, initially I had an 8.33 recommendation and I provided the corrections to an 8.28. If that would be helpful, I could give you what the range would be with my updated numbers, changing it to the 75th percentile. Would you like that range? I don't have to provide it.
Yeah, I think that'd be fine.
That'd be fine?
To provide. Thank you.
It would be between 738 and 908 with a recommendation of 823 instead of 828.
So referring back to your direct testimony at page 16 and at lines 12 through 16, and for what you've provided here, you state that your cost of equity recommendations of 8.33%, parentheses 7.76% to 8.91% for AQUARION is in the middle to upper part of the range of the expectations published by major banks and brokerage houses, parentheses 4.1 to 9.0%, shown in table 5 on page 17, correct?
That's correct, but I believe you're referring to my initial testimony with the 833. The corrected is 828 with a range of 765 to 891.
That's correct. And I am referring to your initial testimony.
Okay.
Thank you. So if we can please turn to page 17 to that table 5. And the return expectations that are stated here are not published by major banks and brokerage houses specifically for utility companies, correct?
would be some utilities that would be included in the companies because they're included in the overall market. But there's nothing here that's for specifically for utility companies.
Okay, thank you. Now flipping back to page 16. And specifically lines 12 through 14, where we state that the ROE recommendation is in the middle to upper part of that range, correct?
Yes.
Do you expect utility returns to be above broad market expectations?
No.
Are investor expected returns the same as investor required returns?
Yes, generally. I have to understand exactly the context, but generally, yes.
So turning back to page 17 on the table 5 that we were looking at, the JP Morgan Asset Management Equity Long-Term Returns of 4.1% is dated September 2021, correct?
Yeah, that's right. There's an updated one since then.
And subject to check, would you agree that the 30-year Treasury yield has exceeded 4.1% in October and November of 2022?
Yes.
Now, referring to your direct testimony at page 5, you observe there on lines 11 through 13 that table 5 on page 17 shows the long-term equity return expectations of pension funds and leading financial institutions for comparative purposes, correct?
Yes.
What is the investment horizon assumed under the pension plan?
For the Horizon Actuarial Services, I believe it's 20 years. I think for JP Morgan, it's also 20. Let me see. Yes, that's what I recall. Horizon Actuarial Services does a survey for a 10-year horizon and a 20-year horizon. And if I believe this is a number for the 20-year horizon.
Now, does a pension manager have to consider the current return of the portfolio relative to the cash flow requirements under the plan?
Yes.
Now, please turn to page 19 of your direct testimony.
Oh, sorry, I'm there.
Oh, no, thank you. And apologies for the delay. Whenever there's a delay, I'm just waiting to make sure that you're there.
Okay.
So on page 19, lines 8 through 11, it states, even if it were assumed that all historical authorized ROEs of water utility companies in other jurisdictions are based on accurate market-based cost of equity calculations, they are from the past. The cost of equity should be based on current market conditions, correct?
That's correct.
Now, you have read Mr. Novak's rebuttal testimony to your testimony, correct?
Yes.
Can you please turn to Mr. Novak's rebuttal testimony to your testimony at page 10 and specifically figure 2? Thank you. Now looking here the lowest authorized ROE reported by RRA for a water utility, excluding ROEs that incorporated penalties, was 8.80%, correct?
Yes, as I noted though, there's an 8% authorized ROE in South Carolina on December 21st, 2021. And there was also for Keo Island was 8.69%. That was authorized in, I believe it was May 2022.
And for what you're referring to, is that a water company or a wastewater company?
Palmetto Wastewater Reclamation Inc. is wastewater. Keo Island, I believe, provides both services.
Did the Kiowa Island incorporate penalties?
No. And PWR didn't either.
So the figure 2, the 8.8% that we referred to on this chart, that was authorized in early 2020. Do you see that?
I don't see in the chart the 8.8.
And I think maybe if we can pull up the chart on the screen, that might be helpful as well. And again, that was page 10 of Mr. Novak's rebuttal testimony to Mr. Rothschild and figure 2.
I see a dot that looks about 8.8, but it's just not labeled 8.8. Is that what you, this one? I would agree it's 8.8. I just didn't, I was looking for a specific number. So I would say I see it, yes.
Thank you, and thanks for the clarification there. And would you agree about the approximate time period of early 2020 for that bullet?
To me, it looks more like mid, around June, but just by the eye. Is that
fair enough? Okay. So in early to June or so of 2020, the 30-year Treasury yield reached a historic low level of less than 1.50%, correct?
Yes. I think it reached 1% at one time. Yeah. Less than 1.5. Yeah, that's one.
And the 30-year Treasury rate is now more than 225 to 280 basis points higher, correct?
Yes.
And is it your testimony that the cost of equity for water utilities has declined while treasuries have increased more than 200 basis points?
No, the cost of equity, based on my analysis, has increased. The important thing, as Dr. Woolridge was discussing, is that the question is what is authorized ROEs in the past, what one didn't go down with interest rates when they fell hundreds of basis points. So I just, as I mentioned throughout my testimony, I don't think authorized ROEs should be the basis of comparison. We have, when there's an authorized ROE, it's applied to book value. We have the market to book ratios of these water companies are trading at about 3 times book, which means investors are earning return on market significantly less than these authorized returns. So they shouldn't be the basis to be able to be consistent with the Supreme Court requirements, because investors can't earn these authorized returns. You can't buy the stock and earn those returns. You have to pay 3 times book value. You're earning less.
Now, turning back to your direct testimony at page 63.
Yes.
And on lines 4 through 5, you state that based on the value of the future expected return on equity -R on the average return on book equity expected by value line, that you adjusted in consideration of recent returns, correct?
Yes.
And are these forecasts that they're referring to?
The recent returns or the value line, future expected return on book equity?
What would your answer be to both?
For the recent returns, no, those aren't forecasts, those are actuals. In terms of,
Oh, I'm sorry, I didn't know you were continuing. Go ahead.
okay, and then in terms of the value line, yes, those are value lines forecasts of future expected return on book equity.
So sticking with value line then, for what period is the average return on book equity expected by value line?
Let me double check. I believe it's 5 years.
Would it be possible for us to provide this as a read-in if Mr. Rothschild didn't just get it while I was talking?
That's okay. We can provide it as a reading. Yeah.
Would that be acceptable?
That's acceptable. Thank you.
Okay, so I believe we're up to read in V. So it's to provide the, with respect to value line, it was to provide the, what, Attorney Hum?
It was asking for what period is the average return on book equity expected by value line?
Okay.
Thank you.
Yeah.
Now, we discussed that value line refers to the forecasts. Is this a market-derived estimate or an analyst estimate?
This is an analyst estimate of accounting returns. Yes.
And this estimate is provided by a value line analyst, correct?
Yes.
So would this be a consensus estimate? Or in other words, does it come from multiple equity analysts or from a single analyst?
This comes from a single analyst. That's why I confirm these growth rate estimates with option implied growth as well, which are consensus from the market as a whole.
So please turn to page 65 of your direct testimony. And on lines 12 through 14, it states, my results are not as influenced by overly optimistic analysts' forecasts as would have been the case had I merely used analysts' 5-year earnings growth rate forecasts as a proxy for long-term growth, correct?
Yes.
Does your characterization of overly optimistic analyst forecasts apply to Value Line's forecasts of earnings growth rate?
Yes, I would be concerned about that for Value Line as well. But it's also important, it's not just being overly optimistic. And that statement I say mechanically using is another very important part, making sure that the math is consistent. A company can't use money that it pays out as a dividend to grow. It has to, the relationship between retained earnings and growth has to be maintained, or it's really doesn't make sense mathematically.
So does your characterization of overly optimistic analyst forecasts apply to Value Line's forecasts of dividend growth rates?
I have not looked at, I heard Dr. Woolridge mention the studies on that, I believe earlier, about the differences between upwardly biased for earnings per share or dividends. I have not reviewed that literature. That's why I take great aims to also consider what the options are saying too, what the option implied growth is, which in this case were quite similar to the results I was getting for Value Line as well. So I'll give you that number. based on my sustainable growth method, I had determined a growth rate of between 6.27% and 6.44. The option implied growth was between 4.5 and 5.73. So at least what the market is saying is those are a little bit high, but at least in terms of the 5.73 are coming somewhat close. But I think that's why it's good to have a check using the options, which show the market thinks it's maybe a little lower growth.
Now, does your characterization from page 65 of your testimony of overly optimistic analyst forecasts apply to Value Line's forecast of the expected return on book equity?
I have not reviewed the literature like with dividends, whether the bias has been shown in their forecast for book value growth.
Now, what is the proxy group average return on book equity that you are applying in your DCF analysis?
Is 9.07% and the median 10?
Well, referring to exhibit ALR-3 at page 1,
do you see that sources where it says value line expectations, median and mean? Do you see the 10 and 907?
I do.
Okay.
So what I was going to ask is in the chart above, under the retention rate part C, is it not the 10.10 and then the other 10.10?
That's right, because I consider the actual returns. Well, first I consider Zacks, which is higher, and also the average historical return has been, higher than Value Line's expectations.
Now, do investors compare the expected return on book equity in other enterprises having corresponding risks when making investment decisions?
Primary consideration would be what they expect to earn on stock price, because I had mentioned before, investors don't earn the accounting returns. They relate that to the stock price. So I think it would, if you look at just companies when it was in the S&P 500, the expected return on book there can vary tremendously from only a few percent to 20, 30, 40%. So clearly investors would only invest in the companies that had the highest accounting returns, but they can't earn that. So would investors consider it? Yes, but what's really relevant is what they can earn, and they can't earn those. They have to buy the stock, unless the market to book ratios were about 1.
Now, sticking with your exhibit ALR-3 at page 1, you include the average dividend yield for your proxy group companies, correct?
Yes.
And this average in footnote A indicates that it's calculated in exhibit ALR-5 at page 1, correct?
Yes.
One moment, please. Thank you. Now turning to that exhibit ALR-5 that's referenced. In the direct testimony that you initially filed for York Water, you included a dividend yield of 0%, correct?
That's correct.
And that's what was corrected in your updated testimony, correct?
Yes, yes.
Now, can you confirm that the averages would increase from 1.77% to 2.06% and to 1.52% to 1.77%?
Could you repeat those numbers?
Yes. So I'm referring that the average is.
Actually, excuse me, I just want to go to my corrected testimony, so make sure that I'm at the right place. Give me 1 second.
You.
Almost there. Yes, I'm there.
So the question was confirming that the averages that were on exhibit ALR-5 would increase from 1.77% to 2.06% and 1.52% to 1.77%.
That's correct.
Now, to discuss your capital asset pricing model, or the CAPM, and referring to your direct testimony at page 73,
Okay, I'm there.
and on lines, I believe it's lines 18 and 19, you state, my spot and weighted average long-term risk-free rates are 3.79% and 3.42% respectively, correct?
Yes.
Now, did you rely on any expectations of interest rates in selecting your risk-free rate?
These long-term yields on long-term U.S. Treasury bonds reflect the expectations of investors.
In referring back in your testimony to page 63, which we've looked at previously,
I'm on page 63, if you were wondering. Yeah.
thank you. And again, at lines 4 through 5, that's where you state, based on the value of the future expected return on equity, -R, on the average return on book equity expected by value line, correct?
Yes.
And value line considers expected interest rates in developing the projections, correct?
I don't know exactly what they consider. I've spoken with them before and I didn't get a clear answer on exactly what they consider.
Now, please turn to page 74 of your direct testimony. Now, here on lines 2 to 3, it states the value of short-term U.S. Treasury bills has a relatively low exposure to swings in the overall market, correct?
Yes.
Are water utility assets long duration investments?
Yes, in general, utilities are long duration investments, yes.
Have 3-month U.S. Treasury bills had significant swings in 2022?
In terms of value? No.
The yield on 3-month US Treasury bills increased from less than 0.10% in January 2022 to more than 4.00% in November 2022, correct?
Yes, but the value didn't change much at all. I haven't provided the calculations here, but I've done that sensitivity. Where I've calculated the beta of these bonds is basically zero, maybe 0.01. It's because when interest rates go from 0 to 4% or even 10%, the value will change insignificantly. On the other hand, if you went from 0% to 4% for 30-year bonds, it would change massively.
Do you consider a swing of 400% to be insignificant?
In terms of risk and beta, yes, that's the whole reason why these are very low risk. I can take I could provide the calculations, but I think $1 million investment in these short-term treasury bills, even a swing like that may be a loss of a couple $1,000s. Whereas if it was 30-year, it'd be hundreds of thousands of dollars in loss.
Now turning to page 79 of your testimony. At lines 2 to 3, you state that you calculate historical betas following the methodology used by Value Line with some modifications, correct?
Yes.
And Value Line is a resource that is widely available to investors and commonly used by investors, correct?
I don't know how investors use it. It's certainly something that in regulatory proceedings and in some circles is used, but I have no idea how investors use them.
But it's available to investors, correct?
It's available, but we don't know how they use them.
And as you just mentioned, Value Line is widely used in regulatory proceedings, correct?
Yes, it's in just about every proceeding I've been involved in, someone's used Value Line.
And Value Line reports beta coefficients, correct?
Yes.
And you have calculated the historical beta coefficients in a manner generally consistent with Value Line, correct?
Except for the modifications.
And the modifications being that you calculated forward-looking beta coefficients or option implied betas, correct?
When I refer to modifications here, I just mean in terms of calculating the historical betas.
Yep. But in any event, you have calculated the forward-looking beta coefficients, or as you referred to, the option implied betas.
Yes.
Does Value Line report any option implied betas?
No.
And does Value Line report forward betas of any kind?
No.
And are you aware that Yahoo Finance, Bloomberg, Google Finance, Reuters, Morningstar, Capital IQ, MarketWatch, or CompuStat all report beta coefficients?
Yes.
And do any of these sources report option implied betas?
No, but I want to emphasize we don't know what investors use their betas for in the models. And we don't know ultimately what models investors are using or what information and how they use it. So I don't know, especially many traders are going to keep their trading strategies proprietary. So we don't know to what degree institutions are using option implied betas or any other kinds of calculations. I'm not aware from any investors that I've spoken with anyone that would just plug in these betas and make a simple calculation. Usually many of them have some type of proprietary or some kind of modifications that I've seen.
But specific to the question, do any of these sources report option implied betas?
No, not that I'm aware of.
And do any of these sources report forward betas of any kind?
Not that I'm aware of. Although they do provide, I don't know about all of them, but in many cases, I know, for example, TD Ameritrade will publish a lot of indicators from stock options, implied volatility, implied skew, and so forth.
So in this case, you've provided more than 7,000 files used for the purpose of calculating beta coefficients, correct?
Yes.
And these more than 7,000 files are used to calculate beta coefficients for 32 companies across your 3 proxy groups, correct?
Yes.
And you have personally developed the software programs for developing the option implied betas, correct?
Yes.
Are these software programs available to the public?
No,
Have the software programs for developing the option implied betas been peer reviewed or subject to any other kind of quality review or certification process?
no, just in terms of reviewing with other analysts.
Are the software programs proprietary?
That's a good question. Will we share this information in all these proceedings? So I would say in some sense, the information is out there for people to reproduce. But in terms of the actual program behind it, we don't share all of that. But everything we provide, anyone could reproduce our numbers. So in that sense, we have shared it in these proceedings. But yes, it is our intellectual property.
And you've developed the software programs for the purpose of calculating beta coefficients, correct?
Yes, and many other, I guess, numbers as well, like option implied volatility, skew, and many others.
Now, turning to page 91 of your testimony.
I'm there, sorry.
Thank you. At footnote 82, you cite Peter Christofferson, Chris Jacobs, and Gregory Vainberg, forward-looking betas, page 24 from April 25th, 2008. Is that correct?
Yes.
Now, in your study period, were any of the proxy companies used in your analysis undergoing large mergers or acquisitions?
Not that I'm aware of.
And in your study period, were any of the proxy companies used in your analysis reorganized and emerging from Chapter 11?
No.
And were any of those companies undertaking initial public offerings?
Not that I'm aware of.
And were any of those companies undertaking large-scale expansions?
No, not that I'm aware of, but it doesn't matter, because the main point of the power of this method is that it can provide an up-to-date how expectations change up to date. We ran a calculation when PG&E was found, this is back in 2018, when PG&E was found to be liable for the Camp Fire, and the historical betas didn't change, but on the very day that investors started to understand this, the option implied betas represented that. And that's an example of the powerful nature of these. They can show investor expectations changing right away. They can also show how investor expectations are not changing. So it's not because they're powerful for showing changes for large developments doesn't mean they're not powerful for measuring when things don't change. I mean, if we say a thermostat is good at measuring the change in temperature, that doesn't mean it's not good at measuring when a temperature stays the same.
Did PG&E enter and emerge from Chapter 11?
At that time, they were not in Chapter 11.
Now, in your study period, were any of the proxy companies used in your analysis making major changes in the composition of debt and equity?
I didn't study that.
Now, on page 24 of the publication that we cited to, it states that these are the circumstances under which the option implied beta method could be applied, correct?
Yes.
Now, also at page 24 of this publication, it states that this method is not conducive to a cost of capital analysis, correct?
It does say that. There is no reason why, in my opinion, this could not be used for that kind of application. And I've seen in terms of other aspects of the study where that has been discussed, in particular, talking about using this method to calculate the cost of equity using LEAPs, and that's option contracts with longer expiration periods. So they do discuss that, and that's why I provide the results for the RFC LEAPs proxy group in this testimony as well.
Now, referring to exhibit ALR-3 at page 3. And here you provide a non-constant growth DCF result for each proxy company, correct?
Yes.
And you have not provided a CAPM result for each proxy company, correct?
That's right.
Is there any reason to change the risk-free rate or the estimated market risk premium for an individual company?
Can you repeat the question?
Yes. Is there any reason to change the risk-free rate or the estimated market risk premium for an individual company?
What's important to, I want to make the point that it's generally, it's a good practice to just calculate the cost of equity for an entire proxy group as a portfolio. But the Dr. Roger Marin, who has been a utility expert witness for many decades, I think Dr. Woolridge had mentioned him, also advocates for that. I'm in a case with him right now in South Carolina in a Duke progress case, and he says the same thing. It's not appropriate to look at the results for individual companies. They should be looked at as a portfolio, and I agree with that. It's also, if you look through Mr. Novak's results, particularly in his risk premium method that he uses on the for the entire S&P 500, I believe it was Phillips 66 had a result of close to 90%. You know, I don't agree with that methodology at all. There are many problems with it, but the results swing around unbelievably there. I think in general, it's better practice to look at it as a portfolio.
So you applied the same risk-free rate and estimated market risk premium across your 3 proxy groups, correct?
Yes.
And in your calculation, is the beta coefficient that varies based on the specific company?
I calculated my estimate based on the average of the betas for the entire proxy group. As you had said earlier, I don't provide the results for each individual company in my CAPM.
So the beta coefficient, though, does vary based on specific company, correct?
For each of the yes, each of the companies have a different beta for whether it's option implied or historical, but I don't calculate the specific cost of equity for each. I just average the betas and do it for the portfolio.
Okay. Can you please turn to Mr. Novak's rebuttal and specifically one of his exhibits, exhibit B-8-JCN-8?
I'm sorry, Attorney Hum, are you referring to the rebuttal to Rothschild or to Woolridge?
Yes, and thanks for that clarification. It's the Mr. Novak's rebuttal to Mr. Rothschild's testimony, and specifically at exhibit B-8-JCN-8.
Thank you.
B-8. Can you repeat that? Sorry.
No problem. B-8-JCN-8.
And the page, just that entire exhibit. Okay.
Yeah, we can start with page 1 and I'll refer to several pages throughout.
Okay, I'm there.
So do you agree that the beta coefficients displayed on pages 1, 3, and 5 are the options implied betas included in your work papers that were used to develop the proxy group average betas that you relied on for your ROE analysis?
I would agree, subject to check, without comparing this to my testimony.
Subject to check, thank you. Now, staying with page 1 of that exhibit, for the RFC water proxy group, do you agree that the proxy group average spot yield on September 27, 2022 was 0.63?
The average spot option implied beta of 0.63?
Correct.
Okay, yes.
This is the same, and apologies for going back and forth to another document because we're going to return here. But this is the same as is shown in exhibit ALR-4 at page 5, correct?
Yes.
So of the 7 proxy companies that you used, how many companies had sufficient data to include in your spot CAPM analysis?
4.
So if you had performed your analysis 1 week earlier, the average spot yield for the RFC water proxy group was 0.82, correct?
That's right.
What effect would a change in the beta coefficient from 0.82 to 0.63 have on the CAPM estimate?
That's why I think I explain in depth in my testimony why the results shouldn't just be based on the spot yield. That's why I also look at weighted 3-month averages. So I would never advocate recommending an authorized ROE just based on the spot. It's very important for any method. Yeah.
So referring back now to that exhibit B-8-JCN-8 on page 2. Using your risk-free rate and market risk premium estimates, do you agree that the change would be more than 100 basis points?
Yes, that doesn't surprise me.
Are 100 basis point changes in the cost of equity typical in the utility industry from 1 week to another?
I wouldn't be surprised. Capital markets are very turbulent. Yeah, I have this book next to me just to remind me of that. It's called The Misbehavior of Markets. That's what it's all about. Benoit Mandelbrot. Capital markets are turbulent. If my method was smooth all the time, I would consider that to be evidence that it's not picking up what's going on in capital markets.
Now turning back to your direct testimony at page 53. Specifically referring to the bottom line on page 21 and on to the next page, you indicate there are only 7 publicly traded water utility companies that have enough data to use in my RFC water proxy group, correct?
Yes.
Now referring back to Mr. Novak's exhibit B-8-JCN-8 at page 1. Now this page shows the 14 weeks used in your weighted average option implied beta estimate, correct?
Yes.
Of the 14 weeks, how many weeks did SJW Group have sufficient data to calculate beta?
1.
And of the 14 weeks, how many weeks did York Water Company have sufficient data to calculate beta?
Also one.
Of the 7 companies in the RFC proxy group, how many companies had sufficient data to calculate beta the week of September 13th, 2022?
Two.
And of the 7 companies in the RFC proxy group, the only 2 companies that had sufficient data for all 14 weeks of your analysis were American Water Works Company and Middlesex Water Company, correct?
That's correct. That's why I explained why it's important to look at the electric companies that have far more options.
And those 2 companies that I mentioned, American Water Works Company and Middlesex Water Company, those are also the 2 companies that had the highest average beta coefficients over the 14-week period, correct?
I don't have the average in front of me. I would agree, subject to check. Yes.
Thank you. Now, the option implied beta for American States Water Company on July 5th, 2022 was negative 0.31, correct?
Yes.
And the beta estimate ranks the relative risk of the company as compared to other companies in the marketplace, correct?
Yes.
So your analysis produces a negative beta for American States Water Company, which implies that this company has less than 0 risk, correct?
Yes, again, you're picking one, there was one negative number in this whole group. Capital markets, as I said, are very turbulent. There are times when we see negative betas. I've seen that also, although very rarely. I've seen it in some electric companies as well. So I think that's why it's important to not focus on individual companies that could betas swing negative. Sure, that happened again when PG&E was going through some of that turmoil in 2018. There were some swings to negative and then positive. So I think that we're picking up some turbulence. I don't know if anything specifically happened on that date with American States Water, but it doesn't surprise me that you would have one number. I certainly would never recommend cost of equity based on a negative beta for one data point out of, I think it's about 90 or so.
So how could a utility company ever have less than 0 risk?
It is possible that for a period of time when a company is going through turmoil, number one, they could actually, for a brief period of time, provide a buffer from risk for an overall portfolio. But I think I wouldn't look into, again, for too much into one number for an individual company. In the case of PG&E, when there was such turmoil, there was no way that company had negative risk. They went from a completely different category in a day. The kinds of companies the kinds of investors that were interested in PG&E changed on a dime. So but so you can't just look at one data point like that and make a conclusion. Absolutely not.
So what does a negative beta estimate suggest for the cost of equity?
Again, I can answer that question, but I don't think, I would not take that and say it suggests that cost of equity for American States Water. Not at all.
Now, do you agree that the option implied beta coefficient for Middlesex Water Company changed from 0.87 to 1.21 to 0.75 over the 3-week period of August 23rd, 2022 through September 6th, 2022?
Yes.
Are you aware of any significant changes to Middlesex Water Company that would have caused the beta to change by that magnitude in 3 weeks?
No, I'm not.
Did Middlesex Water Company undergo a large merger or acquisition?
No.
Did it reorganize and emerge from Chapter 11?
No.
Did it undertake an initial public offering?
Not that I know of.
Did it undertake a large-scale expansion?
Not that I know of.
Or did it make any major changes in the composition of debt and equity?
Not that I know of.
Now, given that the source document for your methodology suggests that those circumstances under which option implied betas would apply, would it have been important to check and to see whether those circumstances would have occurred?
I have gone and looked at that. I didn't find any event. I do that. I often check if there's a big swing, and sometimes you see an event, sometimes you don't. Or at least I'm not that that I'm aware of. You know, I've watched some in various proceedings. Sometimes I've seen different information that is saying being discussed in the room is not publicly available yet, and you can see reactions, but it's nowhere. I only knew it because I was in the proceeding, and so it's hard to know. I can't read transcripts of every proceeding.
So, referring to page 2 of the exhibit that we've been on, and using your risk-free rate and market risk premium estimates, do you agree that the change would be 200 basis points each week over that 3-week period?
Yes, I agree. Again, I don't recommend doing that for an individual company.
And in your experience, do equity investors change their expectations by 200 basis points on a week-to-week basis for utility companies?
I wouldn't be surprised sometimes. No.
Now, if we can turn back to your direct testimony, there's on pages 78 and 91, they refer to footnotes 72 and 81, and they have the same citation. It's Bo Young Chang and Peter Christofferson and Chris Jacobs and Gregory Vainberg from 2011, Option Implied Measures of Equity Risk, Review of Finance, Volume 16, at pages 385 to 428, correct?
I see that on page 78, and I'll trust you. It's on the other page. Yeah.
Thank you. Now, in this article, did the authors observe that the performance of the option implied betas may be improved by adjusting these betas using a predetermined rule, or by smoothing betas and/or moments using information extracted from option prices on other days?
Yes.
Now, referring again to your exhibit ALR-4 at page 5,
yes, I'm there.
and here is where you provide a spot forward beta of 0.63, correct?
Yes.
Now, going back to your testimony at page 89,
I'm there.
and specifically at lines 5 through 6, you state, I start my process with publicly available trading information for all the options for a given security, parentheses, company or index, for a complete trading day, correct?
Yes.
Did you rely on options contracts for a single trading day in calculating option implied betas?
For the spot, not for the for my weighted average over 3 months. I considered it over many different trading days.
So turning back to page 91, forward to page 91, but back to what we were just talking about, that footnote 82, this is the second reference in your testimony to the Christofferson, Jacobs, and Vainberg forward-looking betas from April 25th, 2008, correct?
Yes.
Now, for the purpose of calculating option implied betas, you have relied primarily on options contracts with an expiration date of 180 days in the future, correct?
For my water group, not for the LEAPS group.
And subject to check, would you agree that on page 24 of the publication from footnote 82, that the authors observed that, quote, the main focus in this paper has been on forecasting 180-day ex post betas, which are relevant for certain applications such as abnormal returns. For other applications such as cost of capital calculations, longer-term horizon betas may be needed. We plan to investigate the performance of option implied betas in this context by using LEAPs, as well as option contracts with longer maturities traded on non-US markets, correct?
Yes, that's why I've done that investigation using LEAPs, which has been a fascinating exercise because the term structure of the cost of equity has been decreasing, which has been fascinating to see. When I recommended a 717 ROE for Eversource in RE11 last year, the term structure of the cost of equity is flat, and now it's declining. And that's so I agree with those authors. That's really worth investigating, and we've done that. And I don't know if it's because there's a lot of information, but we worked hard to be able to automate that process. And so we're able to do that kind of investigation. Also, since then, the amount of options that are traded have gone up tremendously, so it's much easier. I think now there are more options that are traded than stock on the S&P 500. So it's much easier to do that.
Do you consider utility returns to be abnormal returns?
I don't understand your question.
So a minute or two ago, we went over that quote from page 24 of the publication from footnote 82. And the first sentence stated the main focus in this paper has been on forecasting 180-day ex post betas, which are relevant for certain applications such as abnormal returns. So the question then is, do you consider utility returns to be abnormal returns?
I still don't understand the question. Can you clarify?
I'm just going to move on. I was referring to the language from the text, but if it's not clear, then I can move on.
Okay.
Referring back to your testimony at page 93, lines 10 through 11 of your testimony there indicates that for the RFC water proxy group, you state that you chose to use 6 months as the time horizon of your option implied beta, correct?
Yes.
Is it accurate that at page 16 of the Christofferson, Jacobs, and Weinberg publication from footnote 82, that the authors observed that, quote, when does the forward-looking beta perform poorly? While we do not have an all-encompassing explanation, it is noteworthy that the forward-looking beta does poorly in a few cases where the average return realized beta is either very low or very high. For example, the average realized beta estimates for Johnson & Johnson and Altria and Procter & Gamble are 0.676, 0.544, and 0.612 respectively, and the forward-looking betas are negatively correlated with the realized betas in those cases.
Can you read that quote again? Sorry.
Is it accurate that at page 16 of the Christofferson, Jacobs, and Weinberg forward-looking betas publication, the authors observe that, quote, when does the forward-looking beta perform poorly? While we do not have an all-encompassing explanation, it is noteworthy that the forward-looking beta does poorly in a few cases where the average realized beta is either very low or very high. For example, the average realized beta estimates for Johnson & Johnson and Altria and Procter & Gamble are 0.676, 0.544, and 0.612 respectively, and the forward-looking betas are negatively correlated with the realized betas in those cases.
I will agree, subject to check, that it says that in the paper, yes.
Thank you. And thank you for not making me read that again.
One more time.
Referring back to your testimony, or specifically the exhibits to your testimony at Exhibit ALR 4, page 5. And this is again where the proxy group average forward betas included in this exhibit are 0.63, correct?
For the spot and then for the historical blended, 0.82.
Now, in your historical beta estimates, you've generally relied on value lines methodology, but you made a modification to the comparative index from the New York Stock Exchange Composite Index to the S&P 500, correct?
Yes.
And this is to align the market return index used in your market risk premium with the market index used in your beta calculations, correct?
Yes.
Now, turning to your option implied beta analysis. In your weighted average CAPM analysis in Exhibit ALR-4, page 4, you use an estimated S&P 500 market return of 10.64%, correct?
Yes.
And for your spot CAPM analysis in Exhibit ALR-4, page 6, you use an estimated S&P 500 market return of 10.98%, correct?
Yes.
Now, please turn to Mr. Novak's rebuttal testimony to your direct testimony, and specifically at page 33, figure 9. And that figure 9 there is an excerpt from your work papers, correct?
Yes.
And specifically, as the footnote states, the source is work paper 2022.7.05.09.27-RFC Water Proxy Group, opt IVA results.XLSX, worksheet summary, cells A1 through J4, correct?
That's correct.
And in developing this beta estimate, you have assumed a 12% market return, correct?
No.
No?
No. We went through that earlier when I was crossing Mr. Novak. That's an assumption regarding the cost of capital for stock options.
Okay, well, thank you for the clarification. Now, referring back to your direct testimony at page 59, and I apologize, this time I'm referring to your updated direct testimony at page 59. Now I'm lagging behind. I'm just a moment behind you. In any event, on line 4, you have the equation for the constant growth DCF model, correct?
Yes.
And you have defined the variables in lines 5 to 7, correct?
Yes.
Applying those variables, you would agree that under the constant growth DCF model, the cost of equity is calculated as the sum of the growth rate defined as G, the dividend yield defined here as D divided by P, which is the dividend divided by the stock price, correct?
Yes.
And just to be clear in the dynamics of the model, if the dividend yield remains constant and the growth rate increases, the estimated cost of equity increases, correct?
If the dividend yield increases, sorry, say that again.
Yeah, no problem. If the dividend yield remains constant and the growth rate increases, the estimated cost of equity increases, correct?
Yes, but the whole point of this method is to make sure that the mathematical relationship between dividends and retention growth stays the same. Yes, I was surprised myself when we removed York Water to 0%. I expected my result to go up and it went down. And that's because with removing that 0% led to it led to less retained earnings for York and the result came down. That's not always the case. It's just because the market to book ratios for water companies are so high, they're over 3. You make those same changes to other proxy groups where the market to book ratio is like around 2, it would have gone up. I don't know where the crossover point is, but certainly for the water companies, they're an extreme with their market to book ratios being so high. So that's why it went down. Surprised me too.
So for the equation for the constant growth DCF model, if the growth rate remains constant, but the dividend yield increases, the estimated cost of equity should increase, correct?
Yes, but again, that's if you're just mechanically not considering the relationship between dividends and retention and growth. Yeah.
Now focusing on the dividend yield, there are 2 components, the dividend and the price, correct?
Yes.
Holding the dividend constant, if the price of a stock increases, the dividend yield should decrease, correct?
If the stock price, sorry, say that again, excuse me.
If the dividend is constant and the price of the stock increases, the dividend yield decreases,
Yeah,
correct?
all else equal.
And the opposite is also true, that holding the dividend constant, if the price of a stock decreases, the dividend yield increases, correct?
All else equal, but not necessarily in a sustainable growth situation or a sustainable growth method.
Now, in your analysis, you had 2 versions of the constant growth DCF. You had the sustainable growth and the option implied growth, correct?
Yes.
So focusing on the sustainable growth model on ALR 3, page 1.
Yes, I'm there.
And this, as we discussed before, is where you submitted a correction to your testimony on November 30th, 2022 that affected this model, correct?
Yes.
And again, the correction was to the dividend yield for the RFC water proxy group, correct?
Yes.
And specifically, your correction was to eliminate the 0% dividend yield that was included in your original testimony, correct?
Yes.
And as you indicated a moment ago, despite eliminating a 0% value in the calculation of the average, your dividend yield increased, causing your constant growth DCF result to decrease, correct?
Yes.
Can you explain again how eliminating a 0% value from the calculation of an average can plausibly make that average go down?
Having a 0% as for York there, and basically calculated through the model that they had, they were retaining 100% of their earnings and using that for growth. So when we remove that, there was less growth for the overall group, especially when you have a market to book ratio that's so high. That's why lower growth. And that's what it resulted. Again, I said I was surprised as well, but when I checked, if the market to book ratios were 1, 1.5, or 2, then you would, as expected, get a lower dividend yield, you get a lower result. But with these high market to book ratios, that's the math, which makes sense. It's very, I think, intuitive in the sense of putting money into your savings account. If you can't just measure how much you're putting in, you have to measure how much you're spending. And if in this case, in the model, it was saying we had a company in there that was saving everything. So that means that it said that the savings account in that analogy was growing, and you removed a 0, there was less savings and less growth and a lower number.
Now, is the reason why the average could go down because your sustainable growth rate is also influenced by the dividend yield, and specifically the dividend yield on book rate that's shown in Exhibit ALR-3, page 1 on line 2B?
Yes, that's why, because the market to book ratio is so high. So it is being impacted by the market to book ratio. Yes.
Now, can you please turn to your comment on the updated testimony that was filed with your correction?
Yes, give me a moment.
So on page 3 of that document, on lines 15 through 16, you state a higher dividend yield results in a lower retention rate and thus lower investor anticipated growth. The net effect of all these factors is not always easily predictable, correct?
Correct.
So if it's not easily predictable, have you performed any sensitivities to your sustainable growth, constant growth DCF model?
Sensitivities to see when the change in the dividend yield would lead to an increase or decrease in the cost of equity result? Is that, I'm asking you, just to clarify, that's the kind of sensitivity you're asking if I performed?
Yes, please.
Yes, because I was surprised myself that the result had gone down. And I mean, I didn't do a formal one, but I did a check and I saw there was a crossover when eventually, if you have a different market to book ratio, the higher dividend yield would lead to a higher result. I don't, again, that was just me doing a back of the envelope to run that sensitivity, and that's what I found.
So as an example of a sensitivity, have you looked at the isolated effects of an increase or a decrease in the stock prices of your proxy companies?
Yes. And in that case, it was as predicted. When you have a higher stock price, the cost of equity result goes down. And when the stock prices go down, the cost of equity goes up.
And holding all other variables constant, I think you described a moment ago that you've looked at dividends.
I'm not sure I understand in what context.
Withdrawn. So holding all other variables constant, for an example of a sensitivity to perform, have you looked at dividends?
Yes, because we removed York. So in that sense, that was a sensitivity. I didn't check, say, at what point if York instead of 0 had been 1% or half. No, I didn't see at what point there would be a crossover. If that's what I understand the sensitivity would be. No, the only one was removing York and we saw what happened. That was it.
And along the same lines, holding all other variables constant, have you looked at book value per share as a sensitivity?
I'm not sure I understand what that sensitivity would look like, so I don't know.
And have you performed a sensitivity with respect to expected return on equity?
I generally don't run that kind of sensitivity. No, I mean, I've seen in terms of the model, if you increase the future expected return on book equity, my results go up. If you decrease it, it goes down. Yes, I've seen that. I mean, I've used this model for decades. Yeah.
And would you agree that changing the stock price would have an effect on dividend yields, market to book ratio, retention rate, and anticipated growth?
Yes.
Now, if you can please turn to exhibit ALR-5 at page 1. If you decreased all of the stock price in columns 9 and 10 by 10%, isn't it true that the indicated cost of equity based on the average market price for year ending September 30th, 2022 would increase from 7.71% to 7.80%?
You decreased all the stock prices in the columns 9 and 10. And you're asking how much would that change the cost of equity result?
Correct.
I would have to run that to see. Are you asking subject to check how much what that would change or?
So I'm asking if that's something that you'd be able to calculate shortly as we sit here.
I did a check myself where I changed the spot. I didn't do exactly 10%, but I changed the spot number up and down, and it changed the as expected. When I increased the stock price, the cost of equity went down, and when I lowered, it went up. But in terms of running 10% for the reducing the high by 10% and the low by 10%. I think it's more appropriate to do the spot. That's more of a direct because you're lowering the high and lowering the low. I mean, that's kind of like you have a couple of different things going on. I don't think that's a direct comparison of what we're trying to see. But I can run a specific calculation using the spot. That's much more of a direct. And it, as expected, you increase the stock price, cost of equity goes down, you decrease it, it goes up.
So is that something that you'd be able to validate as a late file, the statement that I relayed to you, which I'm happy to repeat?
Decreasing the high and the low by 10%?
If you decrease all the stock values in columns 9 and columns 10, so the high and the lows, by 10%.
I just don't think that's doing anything. You're lowering a high and a low. I mean, you might actually have no change because it's an average of the two. Maybe a slight change. It would depend on the numbers. I think more appropriate would be for me to do that for column 8. I just think it's nonsensical to do that for 9 and 10. But if you want to do it, you can. I don't think it means anything. If I can do it for 8, I think that would mean something.
So for columns 9 and 10, it would impact, or isn't it true that it would impact the indicated cost of equity based on the average market price?
But it may not because it's looking at the average, the midpoint of the two. I think it's. I don't know what that would do. I wouldn't conclude it would mean anything.
So maybe on that, Madam Chair, if it may or it may not, may we request a late file to perform that calculation, which I can restate for the record if you'd like.
Thank you. Attorney Hum, can you start by telling me what exhibit we're on exactly, please?
Yes, no problem. So this is exhibit ALR-5, and we're on page 1.
Okay. So the calculation is to assume a 10% swing for rows 9 and 10?
Yeah, so and I'll not to hint at where I'm going on this, but I'm also going to ask about an increase. So I'm wondering if the late file could be a 2-part late file, which I'll state now.
Okay.
So first, if you decreased all of the stock prices in columns 9 and 10 by 10%, what would the result be for the indicated cost of equity based on the average market price for year ending September 30th, 2022?
And specifically increasing by 10%?
Yes, Madam Chair. For the first part of that, what would the decrease be? And then my corresponding second part of the question is, what would the increase be with all the rest of the same terms?
Okay, Mr. Ostrowell, do you have any clarifying questions?
I don't know if I'm allowed to negotiate now, but I just don't think that would be valuable. I'd like to provide column 8 as well, but maybe I can wait for redirect or something. But I can certainly provide that, but I I'm stating now, and I don't believe that provides the answer you're looking for in terms of the movement. I would like to provide column 8.
One
Okay,
moment. We don't have a problem with column 8 being added as well.
okay, thank you. So do 8, 9, and 10. And that is late file exhibit 78.
Thank you, Madam Chair. Now, given the sensitivities that we discussed a few minutes ago, you've specified a DCF model that increases whether stock prices increase or decrease by as much as 10%. Would you agree with that statement?
It increases whether the stock price increases or decreases, is what you're saying?
Correct.
No.
Would you agree that if stock prices increased by 5%, 10%, 15%, even 100%, your model suggests that the cost of equity increases, correct?
No.
Madam Chair, may we have one moment, and if it's an appropriate time for a break, we may not have any more questions, but I just want to confer with my colleagues, if that's okay.
Okay, we can take a 5-minute break.
Thank you.
Can you tell me what was going on? Can I help?
How would that come back? I know I'm first. I haven't seen anything like that.
Thank you. Please be seated. Attorney Hum?
Madam Chair and Mr. Rothschild, I'm happy to report we have no further questions.
Okay, very good. Thank you.
All right.
Thank you. Thank you for your
And I
time.
won't ask you to read that quote again.
Thank you.
All right, very good. Attorney Marshall? No questions. Who do we have next? Attorney Will? Okay, very good. If we can approach.
Good afternoon, Mr. Rothschild.
Good afternoon.
My name is Tom Wheel. I'm a staff attorney for the Office of Consumer Counsel. We've met on a screen before, but it's good to meet you in person. I also wanted to say on behalf of OCC, I wanted to thank you for your flexibility in accommodating our witness swap request. I'm sure that it had an impact on your schedule as well, so we appreciate that. I have just a few questions. I think the company's first question for you pertained to a reference in your testimony to an applicable legal standard, the applicable legal standard pertaining to comparative risks. I want to start in the same area. Does your analysis consider the level of financial risk to which Aquarion is exposed?
Yes. I mean, the main measure is that I use is on the capital structure ratios of the proxy group. And I do consider in terms of the credit reports and what they were saying. So that is they address in the Moody's reports the financial risk. Yeah.
Thank you. I heard the company's witness say in response to, I believe, your cross yesterday, I heard a distinction drawn, and correct me if I misheard it or if there is no such distinction. I think I heard a distinction drawn between a company's risk and investors' perception of risk. Is there a distinction between those two concepts?
Yes, there can be. Markets can be, as I was mentioning, can be turbulent, and you can't be completely sure that investors' perceptions are in line with actual risk. I mean, it's a little hard to say exactly what's the actual risk. So in my testimony, what I really focus on is looking at investors' perceptions is the really main focus. That's why I use stock options and so forth. So I would say in general, the data shows that investors do perceive utility companies as lower risk. You can see it particularly in the skew index analysis that I do. The investors show that they consider there's a much lower chance of a large drop for utility companies than for the overall market. So that's consistent with it. But I just have to say that it's whether it's the value companies or the actual risk, you can't be sure that investors are getting it right all the time.
Right. And I think I'm going to get to that in a second. Does your analysis, well, we already heard you testify that about the portion of your testimony that does consider returns on equity allowed in other jurisdictions for other utility companies, right?
I provide some examples, yes. Yeah.
Okay. And do you recall there's, I believe the company's witness rebuttal testimony discussed this as well, and there's a chart that's been referred to several times during this hearing that shows comparative allowed returns on equity, and it highlights particularly the recently allowed Connecticut water return of equity of 9%, and showing that is visually on that chart strikingly lower than the other allowed returns on that chart. You familiar with what I'm?
Yes, I'm just getting to the chart to review it again. Yeah, I see the chart, and it shows Connecticut water as 9%, which there is another one that's lower, but it's yes, I would agree with your characterization. Yeah,
thanks. You testified about this a little before, but can you describe the weight that your analysis affords to ROEs allowed in other jurisdictions?
Well, I just try to make sure to emphasize that the market to book ratios of water utility companies are 3 times book, and authorized ROEs are applied to book. So it is just the simple math shows the investors' required return or their expected return is significantly lower than these authorized ROEs. Yeah.
Thank you. So is there a reason that PURA, in determining Aquarion's ROE, couldn't just look at ROEs allowed in other jurisdictions and base its ROE on those numbers?
Yeah, absolutely. Couldn't. Then it would no longer be market-based. And that could be dangerous even for utility companies. There was a time in the 80s when interest rates were high where the market-to-book ratios for utility stocks went below 1. And if you looked for authorized ROEs at that time, they would have been too low for utilities, which would have been dangerous. And the case now, when the market-to-book ratio is too high, it's certainly unfair to consumers and not consistent with investors' expectations.
And am I wrong in assuming that there'd be sort of a feedback loop effect if all regulators turn to the decisions of other regulators in establishing ROEs, that you'd end up with a system that was entirely self-reflective and potentially stagnant, if not mostly inclined towards constant increase? Are those fair assumptions?
Absolutely. It's I could understand why commissions would want to look kind of as a check to other authorized ROEs, but if we do that, there's no way that we can be sure that we're changing with capital markets. As Mr. Novak had admitted, capital markets change. We have interest rates going up. My models are picking that up. My results are going up considerably over the past year, and it's critical. If we just go to authorized ROEs, we can't be sure that we're tracking the markets.
So is it your position, and I'm not asking for a legal opinion, but is it your position that the reference in your testimony to the legal standard about comparative risk, that doesn't mean that the notion is that we just compare authorized ROEs with other jurisdictions in order to establish what's a sufficient return for a company?
Absolutely. I couldn't imagine how it could be compared to other authorized ROEs. It has to be related to what investors can actually earn, and can earn the authorized ROEs with the market to book ratios for water of 3.
Thank you. Speaking of changes in the market, there have been a few references in this case to interest rates generally, treasury yields specifically. Did you consider the 10-year treasury yield in your analysis?
I didn't. I review interest rates, so yes, I did consider that. I do consider the 10-year yield and the full term structure of interest rates. Specifically, I did not use the 10-year as a risk-free rate in my CAPM. I used the 30-year and the 3-month, but it is something that I follow. Yes.
Okay. And well, what does generally the 10-year treasury yield tell us about a regulated company's return on equity? What's the connection between that data and determining an appropriate return?
I would say, generally speaking, as it increases, I've found you're going to have an increase in the cost of equity. As it decreases, as it increases, an increase in the cost of equity decreases a decrease in the cost of equity. It's not certainly many variables, and not can't tell for sure if it's 1-to-1, but I've seen that in my model results. They've gone up with interest rates in the past year.
Okay. And are you aware of any recent changes to the 10-year treasury yield since you filed your testimony?
Yes, it's fallen considerably since. Actually, I have to see. I know it's fallen considerably recently in recent weeks. Yes, it has been. It has fallen. Yes.
Okay. I'm going to move on to a couple questions about options. I just want to make sure I understand. You testified earlier about the expectation of return for investors. And I heard you say that the primary concern of an investor is the stock price and not necessarily the company's earnings. I took that to mean, am I right in saying that your position is that a company's earnings can be a consideration and can therefore potentially influence a stock price depending on the degree to which investors are paying attention to it, but that the primary mover in your mind is the price itself?
And can you point to where that is, or is it just a general question?
It was a general question. It was, I may have misheard you. I think it was in response to a question you received from the company, the difference between a company's earnings and the company's stock price in terms of what investors are focused on.
Well, I think in terms of, if I think of the DCF, if I recall, there was quite a bit of talk about that, as there always is, in terms of whether earnings per share represents the appropriate growth rate in the DCF. And I mentioned that you can't mechanically do that. They only line up in terms of what would be a reasonable expectation for sustainable growth from time to time. In terms of looking at stock prices, and stock options, yeah, that's where you can really see a great measure of where investor expectations are, and they provide a lot of information in terms of implied volatility, option implied betas, option implied skew. And in those cases, there's no need to look at earnings, even if they certainly could be impacting those stock prices and stock options, but you can see it within the stock prices and stock options.
Okay. Do prices and options ever increase, or I suppose decrease, even if earnings don't increase or decrease correspondingly?
Yeah, they're not always connected. You can see earnings surprises and the stock price can increase, but you can also see earnings increase, but it wasn't a surprise. I think that's what's a common what can be confusing sometimes. Well, the company had incredible earnings and the stock went up or even down. But the important point is investors may have expected that big bump up in earnings, or they may have even expected a greater amount of earnings. So, yeah.
And can't there be situations where earnings are essentially divorced entirely from prices? Like, for instance, the stock price of a company like GameStop or AMC Theaters?
Absolutely. That's a good sign of turbulent markets in the extreme. Yeah.
Okay. So there are other factors, it sounds like, that can influence the price of stock or options other than earnings?
Absolutely, including herd behavior and so forth. Yeah.
What about a company's environmental, social, and governance framework? Can that impact stock or options pricing?
I haven't done an investigation to that specifically, but I wouldn't be surprised. And I have read some literature that did discuss that.
Thank you. So it sounds like, I think I just heard you say that the reason that you're considering options in your analysis is to try to more accurately determine investor expectations than just sticking with earnings data. Is that correct?
Yes, exactly. I mean, anything that's published by analysts, whether it's their expectations or accounting returns or so forth, yeah, we want to look directly to where the money is coming from. And that's why it's valuable to use the stock options and because that's where the money is, the investors.
Do you have any evidence that options applied betas are forward measures of historical betas for utility companies?
Yes, I've done a study where I showed that during the outbreak of COVID in March to April of 2020, historical betas of all lengths, not all lengths, but 5-year, 2-year, 1 year, 6 months, they all increased. So did option implied betas. And then after that, the option implied betas decreased within, I think it was a month or so. And then following that, like a waterfall, where historical betas falling to 6 months, then the 1 year, 1.25, 1.5, which is, to me, almost like artwork in terms of its demonstration that these option implied betas were a measure of investors' expectations, but in particular in this sense, what historical betas were going to be in the future. So it seems like investors got it, that 5-year historical beta is no longer representative of investor expectations. And then they, sure enough, they fell down.
And you mentioned you did a study on that. Is that included in your testimony or in any of the adjustments you filed since you originally filed your testimony?
No, I didn't provide that specifically in my testimony.
Madam Chair, could I request a late file of the study Mr. Rothschild is referring to pertaining to forward measures of historical betas for utility companies?
Okay, so that's late file exhibit 79.
And do you have any questions about that, Mr. Rothschild? Am I referring to that correctly, this study?
Yes.
Thank you, Madam Chair. Just a couple more questions. A question that's similar to the question posed by the chairman to Dr. Woolridge earlier today. Have you ever provided consultation in a case where a company's return on equity could be adjusted by any kind of adder, such as the small water company acquisition adder within the company's application here?
I have seen those kind of adders in Pennsylvania.
Okay. Have you seen more specifically a scenario where return on equity could be adjusted either up or down via a performance-based mechanism or any kind of metric tied to a company's performance of its services in accordance with goals that are kind of pre-established by a regulator?
I haven't been exposed to that very much. I've heard a lot of discussion about that and a lot of debate, but I haven't that I can recall been where there was where the ROE could be increased based on performance, other than the adders for, say, acquiring struggling water systems. But so it's kind of like a performance, but it's but not specifically a performance adder for ROE, no.
Okay. Would those kind of adders, those performance-based adders or penalties, I suppose, those kinds of mechanisms, would they impact the analysis of determining the appropriate level of return? Or would that be something that would the appropriate level of return be established first, and then those adders would be applied against that appropriate level of return, in your opinion?
I guess I see it somewhat similar to Dr. Woolridge in a sense that that's kind of an administrative decision, how that's done in terms of if you had comparing a proxy group of companies that had some kind of performance adder versus not. I just haven't done that analysis, but generally I haven't done that study to see if some kind of performance adders would impact the cost of equity. No, and I just haven't.
Yeah, my question was sort of more of a mechanical one, and it's fine if it's outside of where your experience lies. But my question was more the mechanics of regulation, whether that kind of manipulative factor to return on equity would need to be baked into the analysis of the appropriate return on equity, or if you could instead establish an appropriate return on equity, like you could, after an analysis similar to yours, for instance, it could be decided that subject to analysis just like yours, that the appropriate level of return on equity is, say, 8.25%. That then after that, the regulator could decide, but in order to earn that 8.25%, you would need to be held to certain performance expectations, or would those performance expectations have to be included in the analysis of establishing the end result return on equity?
I would generally start by getting the result from my proxy group and focusing on that, and then I would have to investigate the specific performance measures and see if that would or would not impact the actual cost of equity. But as a start, I don't know if that answers your question, but as a starting point, I would look at the proxy group primarily and then have to investigate the specifics of the performance mechanism.
Okay. Thank you. Just a couple more questions. Is there a single universal uniform analysis for determining an appropriate return that's used in multiple jurisdictions?
No.
Are you aware of any requirement that all components of an analysis must be adopted in another case prior to a regulator accepting that component of an analysis?
No.
Because if that were the case, similar to my question before, if a regulator could only adopt a kind of analysis if it had already been accepted elsewhere, and it seems to me logically that would result in a closed loop system again, where there could never be any adjustment eventually to how returns on equity are established. Does that sound right to you?
Yes, absolutely. That's been what's been so wonderful in South Carolina, getting a lot of the approval of the option implied method to set rates, and there's been a lot of it's been very, very encouraging, and was a lot of debate in the hearings there, saying, what changes from unconventional to conventional. If you're always saying it has to be conventional, there's no possibility of change, and that would be, I think, devastating to any system. We couldn't have any progress. That's why I was asking Mr. Novak about science in general. I think that's important to be able to have progress.
And it seems to me that also wouldn't reflect what you testified before, that the market is a constantly changing entity, right? So that wouldn't match. It wouldn't make sense logically to have an analysis that's examining the market, but a system where the format of that analysis was resistant to change despite changes in the market.
Absolutely. That's what we learned, especially from the financial crisis. People are saying, we've got the model and we figured it out. No, they didn't. Things change, and you have to even constantly question your models and develop. Yeah.
Thank you. No further questions.
Thank you. Attorney Wright.
Thank you, Chairman.
Thank you. All right, Mr. Novello.
Afternoon.
Good afternoon.
I too will be brief. Just a couple of questions regarding the capital structure and your recommendation. You've included short-term debt in your capital structure, correct?
Yes,
And you think it appropriate to use short-term debt for rate-making purposes in this rate case as well?
yes, because I've seen no evidence that that shouldn't be the case. They provided some material in the rebuttal that it doesn't change my opinion at all. They didn't explain how AFUDC rates were calculated or anything, so.
Okay. Referencing pages 7 and 8 of your pre-filed testimony. You stated it would be appropriate for the authority to consider a reduction in the authorized ROE with a higher equity ratio. Why do you make that conclusion?
There's lower financial risk if a company has more equity, so lower leverage, less debt, so that would impact financial risk and the cost of equity. Yeah.
And your regression analysis gives a numerical quantification to where the authority should lean if depending on where the capital structure lies.
Yes.
Okay. Thank you. And do you think Aquarion's risk profile is in line with other companies in the proxy group?
Yes, from everything that I could see, there's no reason to think it's any riskier than the proxy group.
Okay. And do you think that Aquarion's risk profile merits a higher recommended ROE as proposed by Mr. Novak?
No.
Okay. And one final question. What does the expected earnings approach measure?
As Dr. Woolridge was explaining, it's just measuring expected accounting returns. It's not market-based.
Okay. And do you think it's an appropriate measure for the cost of capital?
No, I agree with FERC that it's not.
Okay. Great. Thank you. That's all I have.
Thank you.
Thank you.
Thank you. Okay, so we'll turn lastly to questions from the bench. Commissioner Karen.
There's a couple, I guess. So we've heard a lot today concerning the fact that historical data points essentially don't have that much to do with setting an ROE going forward. So it occurred to me that, should we be opening up the ROE portion of a rate case every 3 to 6 months so we're sure the ROE is always accurate, or as accurate as we can get it for the actual times we're trying to address?
It's a great question. No, I think would be burdensome to do it every few months. I mean, that is a kind of
Full employment act for consultants.
That'd be too much, even for a consultant. That wouldn't be. I mean, one way to deal with that would be potentially having some mechanism that would update regularly. I mean, you have cost of capital mechanism, for example, in California that updates every year based on interest rates. So that's one way. They only have the cost of capital proceedings every few years, and they at least do it yearly. Could you do that monthly? I guess. Yeah, but I think it would be, a large burden. I guess if in the 3 to 6 month timeframe something radically changed, I guess you could consider doing it. But on a regular basis, I think that would be burdensome. Yeah.
No, I suspected as much, but to hear the discussion going on in the back and forth, it really sounds like, why would we even study some of the historical data if it's irrelevant? That's being put.
I wouldn't say irrelevant historical, but it's just critical to recognize that capital markets do change. And I really think it wouldn't be appropriate to use, say, for example, 1% interest rate on the 30-year that it reached in 2020. That wouldn't be relevant to today. I think that would be obvious. The same would be the historical betas that Mr. Novak uses. They're 5-year historical betas. They're elevated because of the turmoil during the initial phases of the pandemic. I think that's not appropriate. I think we should do our best to estimate where we are today. And there are clearly some changes, like interest rates are up, inflation's up. I think we should admit that. We don't know exactly what interest rates will do. It was surprising. The 10-year took a big dive recently. Who knows what it'll do? So that's just what we're up against with capital markets. They are unpredictable, but that's why I do some smoothing in my numbers as well. I get it. We don't want to be jumping around every day or.
I understood, and I think from a commission's point of view, I mean, you want stability as well for not just the company itself and its customers, but certainly for the investors as well. We don't give them short shrift either. We want a strong company to attract capital. You talked to, well, both you and Dr. Woolridge, the questions came up concerning implied option betas. And yet, no, you look at them and yet you don't use them in your calculations. And again, I recognize what you're saying, that it's a way to find what the volatility is at the moment. And so I guess the question is, why do you look at the trends in terms of that? Or should we be looking at those kind of trends in terms of the actual risk, in the immediate future?
Well, just to clarify, I do use them. I use the option implied.
In the calculations?
In the calculations.
Okay. So,
yes.
Okay. Was that Woolridge did not, and I think Mr. Novak did not.
No, they didn't use it.
Okay.
Yeah.
Okay. Thank you. Okay. That's it. Thank you, Madam Chair.
Thank you. Mr. Vice Chairman?
I just love listening to, I love listening, having been here a very long time, to the ROE debate back and forth. And I sit here and I always say, how are we going to digest all this and come up with something that everybody's going to be happy with it? And somebody's going to be unhappy with it, because it's kind of a he said, she said type of thing as you sit here and go through this process. But I thank everybody for their testimony.
Thank you. Mr. Rothschild, are you generally familiar that the AQUARION company has access to in Connecticut revenue decoupling mechanism and earning sharing mechanism and WICA?
Yes.
What is your perspective on how those mechanisms combine to affect the risk profile, directionally speaking?
To lower the risk. Yeah.
Thank you. Do you have an opinion about what the purpose of an ROE adder is?
My understanding in Connecticut, and I think it's similar to like Pennsylvania, the ROE adder can be used to incentivize water companies to purchase whether troubled water systems. I've seen it used in that way. Yeah.
Thank you. I should have been, I'm asking like much more broadly, not specific to any one adder or water sectors. Do you have an opinion about what the purpose of an ROE adder is?
I guess I've seen it also in FERC when they've done it for transmission planning to incentivize certain behaviors is most of what I've seen, whether it's to deal with congestion issues in transmission. So to incentivize a company to do certain things is what I've seen it, the way that I've seen it used.
Thank you. Incentivize meaning forward-looking? Meaning you're trying to incentivize future behavior?
Yes, to build in that case with FERC did that to incentivize transmission builds in the future, yeah.
All right, thank you. I have no further questions. Attorney White, would you like a moment to consider redirect?
Please, yes, ma'am. We can just have 5 minutes.
Okay, let's take a 5-minute recess.
He's got very self-centered. Sorry.
At least the Bears are going to hibernation. But yeah, I'm sure they're out there. Sure. New Zealand. Just like he was stitched up. So maybe with lead pipe or something. Yeah. Great. That's it. It doesn't have pretty well. You know, you're directly.
Thank you. Please be seated. Okay, we'll go back on the record. Attorney White, any redirect?
No, ma'am, EOE has no redirect.
Okay, very good. Mr. Ostrell, you are excused until the late file exhibit hearing, please. Thank you. Okay. So that completes our witness panels. for the evidentiary hearing portion, I do have a couple of administrative matters to go over. So I'd actually ask that the company's counsel, if you could approach. I have a question. Okay, thank you, Attorney Pace. Are you familiar with correspondence that was filed yesterday from an intervener in this matter, Smart Water Westport?
I have not looked at the correspondence, Chairman.
Okay, I believe Ms. Zabo filed a response yesterday. So the correspondence alleges that the company has not responded to a set of interrogatories that Smart Water has levied. So I'm trying to get to the
Sure,
bottom.
Chairman. Yes, I can provide the context. Subject to check, it was my recollection that the final set of questions that was issued by Smart Water was issued well after the authority's deadline for issuing discovery. And so our conclusion was that if questions are issued after the expiration of the discovery period, the recourse would be for the party or intervener to appear in the proceeding and ask the company to provide information in the form of a late file exhibit. It was our understanding that the authority schedule applied to all parties and interveners, that there was no special treatment or exceptions to Smart Water, and therefore they'd be expected to comply with the authority's discovery rules. We did respond to all the interrogatories that they issued during the discovery period. We responded to those in writing, but this set was issued well after that deadline.
Okay, I appreciate that, and I'm not going to dispute anything that you just said. I think the outstanding question for me is the allegation that the interrogatories that were propounded on the 22nd were repeating interrogatories that were issued before the discovery period closed, but were not answered satisfactorily. So having not gone interrogatory by interrogatory myself, I think what I would ask the company to do is to complete that exercise, and if any of the interrogatories that were issued labeled as interrogatory 26 through 36 that were issued following the close of discovery, if those correspond to interrogatories that were issued before the discovery window closed, and any of them had an incomplete or otherwise non-responsive answer, it asks that you update those responses.
Of course, Chairman, we're going to follow what the authority says and provide the authority with the respect it deserves in terms of doing that due diligence. What I can say, though, is when we did receive the interrogatories that were timely issued, we spent a considerable amount of time researching those and responding. And so we took them very seriously because they are a participant in the proceeding, and we provided information that was available to us using best efforts in that time frame. From my perspective, I think the disagreement is we provided the best information we have, and the entity issuing the discovery is simply not satisfied and somehow thinks we have more. But I'm not aware of any additional information we have, but I want to comply with the chair's directive, which is to go back and look at questions 26 through 36 and see if there is anything else we have. My recollection is the answer is no. We did our best efforts to provide what we had in the initial round. I'd also point out too that from our perspective, the discovery is being used to really advance their objectives in a separate docket. And if there's additional discovery they want issued in that separate docket, looking at the tanks in Westport, they can issue additional discovery there. My recollection is that that proceeding will reinitiate in the March timeframe.
Okay, I appreciate that, and I will accept the company. I will accept if the company can go back through those interrogatories and confirm for the record that you've provided the best information available.
Of course, we will do that and follow up in writing, Chairman.
Thank you. A correspondence would suffice, and if you do find anything that needs to be supplemented, I'd ask that you do so through the normal process for supplementing a response.
We will. Thank you, Chairman.
Great. Thank you very much. That's the major administrative item. The last three are just reminders. And then I will take up any administrative matters that any of the parties or interveners would like to bring to our attention. Just a reminder, the late file exhibits that were issued yesterday and today are due December 12th. So in total, I registered 79 late file exhibits. They were largely issued to the company, a handful to OCC, and I believe 3 to EOE. So I think everything has been uploaded into Lotus through yesterday. The 3 prompts from today will be uploaded promptly. So I would ask that during the last 2 announcements I have to make, that parties, attorneys, parties and interveners, attorneys confirm that you have the same understanding. We have 79 late file exhibits. No one's walking on here with a different understanding. And number 2, make sure that everyone's clear on the due dates, because we had 3 rolling due dates for those late file exhibits. If that is clear to everyone, then when we adjourn today, just at risk of stating the obvious, tomorrow's hearing date will be canceled, which will mean that we will reconvene for late file exhibit hearings on the 14th and 15th. Starting at 11 a.m. on the 14th and 10 a.m. on the 15th. I would ask that all parties and interveners planned for only a 30-minute lunch on both of those days due to the time constraints that we will be facing. And then just a general reminder that the evidentiary record closes on the 15th at the conclusion of that late file exhibit hearing. Are there any administrative matters before we adjourn? Attorney Datras, please.
Thank you so much, Madam Chair. Julie Datras for the Office of Consumer Counsel. I just wanted to provide an update to the authority regarding a response from the OCC to interrogatory RRU 449, which requested the OCC to supplement the blue chip economic indicators and the blue chip financial forecasts through the last date of the hearing record. So the OCC will have those updates from November by the end of this week. However, we are, as I stand here today, we're not certain if we will have December's by the close of this record. And so just looking for direction from the authority if we should file them nonetheless when we receive them, or if we should not, if we do not receive them before the 15th.
I appreciate the question. Since the evidentiary record closes on the 15th, let's go ahead and only file, if you only have access through the end of November, then you can file just those at the time. Thank you. That did remind me, was it the OCC or EOE who had the read-in V? It was, okay. Okay, EOE, are you prepared to provide that read-in, or do we need to translate it into a late file exhibit? Okay, all right. Attorney White, would you mind approaching? I don't think my prompt was. I don't think my scribble is enough for me to go on. Was it directed to EOE, or was it someone to? It was directed to EOE. Okay, and it was the company's request, right?
Yes, ma'am.
Okay, so I'm sorry. I should be looking at Attorney Hum. I think it was provide the period for average return value line.
Yes, and thank you, Madam Chair. That sounds right. I would need to double check my notes to confirm, which I have back at my seat in the back of the room.
Okay.
But that does sound right the way that you described that.
Okay, thank you. If that's enough, so I guess the question to EOE is, was that clear enough for the late file exhibit prompt?
Yes, ma'am. What I had written was the average return on book equity expected by value line. So I believe that corresponds. Yes, ma'am.
Okay, thank you. All right, then strike the earlier response or the earlier prompt. We have 80 late file exhibit requests in total. Okay. Any other administrative matters? Okay, all right, very good. Then I want to thank all of the parties and interveners and their attorneys and stakeholders and witnesses. Thank you for your participation over the last couple of weeks, and we will see everyone back in the hearing room for an in-person late file exhibit hearing. Thank you.
Wow.
Yes. Nice to see you.
Yeah, you too. Yeah, well, yeah, see you
I'll
next
see you
week.
next week.
Thank you.
Thank you.
Thanks so much. We'll see you next week.
Yeah.